Okay, ladies and gentlemen, welcome, and we'd like to call to order the Rutherford County Benefits and Insurance Committee. And the first item on the agenda, I believe, is approve the minutes of the last meeting. Do we have a motion concerning those minutes? All right, we have a motion. Second? Ms. Hickerson, did anybody have any corrections or additions? If not, all of you then in favor of that, please say aye. Aye. Any opposed? Thank you very much. Next, we're going to get a report on the financial condition from Mrs. Stinson.
If you refer to your financial reports, we'll begin with Fund 264. For the month of March, our per employee per month cost was $745.75 in our medical plan compared to prior year of $664.77. That makes a year-to-date average of $811.05 compared to year-to-date average ending last year of $803.71. When we combine our on-site medical experience, our per employee per month cost rises to $779.64 compared to prior year of $698.80. With year-to-date average of $846.22 compared to prior year of $834.88. For Fund 266, at the end of March, we're at $617,893.74 compared to prior year of $833,457.70.
Okay, that's the report on the financial condition. Does anybody have any questions? You need any further elaboration? All right, then.
We're ready for the next one. And those are just handouts for information.
All right. Now, the next two things we have on the agenda, as we told you before, since this is going to be an elongated meeting, you have a report on the workers' comp and OJI, and also a report on the wellness. So, assuming you've already read those without objection and with your consent, we're not going to have any further discussion about those two items today. Does anybody have anything they want to say about those? Okay, thank you. That being said, we'll move on to agenda item number 5, and this is for our life insurance and accidental death and disability bids, and we're going to recognize Mr. Brown with Cowan Benefits and Ms. Stinson, and they can carry us forward with that discussion.
All right, I believe in your packets you should have a couple different spreadsheets. One has the life insurance at the top, so there's 2 with life, and there's 1 with short-term disability. We bid out the life insurance this year, and we looked at multiple carriers. Last week we brought in 2 finalists on the life insurance, MetLife and the Hartford. And so those are the 2 that are highlighted on the spreadsheet. If you look at the first page of the spreadsheet, when we look through just the cost of what we're considering your basic insurance. So, you hear me?
Yeah, get into that mic a little better.
You may be a fish to talk.
Let's see, is that better? Can y'all hear me?
Better.
Good.
And have all of you got your spreadsheets in front of you? Have you found those now? Okay.
When we went to review the proposals and looking at the cost of Met and Hartford compared to the standard, the 2 carriers did different kind of methodologies. When we compare the first page, standard's renewal proposal for the year was a decrease of 8%. So you see the yellow line at the bottom represents the dollars and the percent increase of the basic coverages. So those are really the employer paid, county paid coverages. If you look across at Met, they're showing an increase of 6.5%, and then Hartford is also showing the largest decrease of 12.9%, or $34,000 savings. On the next page, we compared the employee paid benefits. So these are the supplemental life insurance for the employee at the top, and the gray lines at the top. The spouse rates are the second group of rates. There's a rate a little further down you can see there for the dependent life. And when we look at these rates, there's 2 yellow lines at the bottom. The first yellow line shows the percentage increase or decrease in the cost impact to the employee. And on here you can see the standard is producing a 12% increase to the employee for the supplemental insurance rates. Met is producing a 27.4% decrease, and the Hartford is representing a 3.4% decrease. And then behind that, below that, down below, is the combination of the two pages. So if we want to look at the proposal overall, you would see there that MetLife is representing the 17.8% decrease compared to the current renewal of 6.3% and the Hartford of 6.1%.
If I could interject, one other number that we didn't reference, but that was a consideration during the last bid process when the contract was awarded to Standard, is the retiree rate, the retiree premiums. So if you will look at that, that's actually on your first page. You'll see that Standard held their retiree, it's actually the third column down. They held their retiree rate flat. MetLife took an increase from 54 cents per 1,000 of coverage to 72 cents, and Hartford maintained theirs flat as well.
So in reviewing the two proposals, or actually the three proposals, we looked at the total cost, but then we also wanted to look at who balanced the program out the most. Is there some savings to the employer? Is there some savings to the employees? And we really compare those two spreadsheets together. The Hartford proposal actually showed a savings to the employer of 12.9% and a savings to the employees, as you can see there on the second sheet, of 3.4%. We also compared the plan design. For the most part, the plan design for both of these, this is the life insurance, is consistent for all three carriers. The one difference there is when we moved from Hartford over to Standard 3 years ago, Standard did offer an in-line of duty benefit, if you remember, on the accidental death and dismemberment. So the employees of the county that were in line of duty, if they were have an accidental death or dismemberment, the benefit was 2 times the current benefit. We asked that of these carriers. The one difference there is Hartford only is able to provide that benefit for accidental death, not dismemberment under their contract. So that's one difference of the contract that we're aware of between the two. Hartford also offers an open enrollment. So if you do not have benefits today, if you do not have the supplemental life insurance and you would like to add that at open enrollment, they're allowing you to go up in $10,000 increments each year without completing an evidence of insurability.
And that is a little bit different than what we had when we moved to Standard. When we went to Standard, we had a full open enrollment, which means that you could elect up to the limits. The reason the Hartford is doing the $10,000 increments, which would mean that over the 3-year rate guarantee and contract, someone who doesn't have insurance today could have $10,000 first year, elect an additional $10,000 second year, elect an additional $10,000 third year, for a total of $30,000, which for someone who's uninsurable, that's still an option for them that wouldn't be available otherwise. The reason they're doing that is because we've had some experience on our life insurance where we've had some adverse selection, where individuals have elected the insurance and then we've paid a claim within a relatively short period of time. And that is part of the reason why we heard during the interviews as to why the rate increases were taken at different locations in each of the bids.
Essentially, from the move from Hartford to Standard, we did the true open enrollment, and we had around a 20 to 25% increase in participation in the supplemental life insurance because they did a full true open enrollment. And since then, also, the claims have gotten worse, as we said. So that's why Hartford's not really wanting to go down that road again. Plus, just 3 years ago, we had such a big increase, it makes it even more risky to offer it again at this point. Now, the MetLife proposal, as you can see, overall, it is a lower proposal. It's not weighted, balanced between the employer and the employee as much. That proposal, they did match the AD&D benefit for in-line of duty, so we do want to note that for them. But I believe at this point, when we look at the differences, it looks like there should warrant a recommendation to consider MetLife and Hartford because both of those carriers are lower than the current Standard proposal.
So when we look at where the advantages would be to MetLife, you look at and you tend to focus on the supplemental employee life insurance. That's where the substantial savings and why their percentage of savings is what it is with MetLife. We have about 1,781 employees that take supplemental employee life insurance, but the county pays the basic life insurance at $35,000. We pay 100% of that premium for all of our employees who are full-time status. So when you look at where the bigger money lies in terms of for the county, you can see the total volume on the first page right below the rate per thousand. So when we went into the bid process, we hoped to achieve savings because of the bid, and that drives the competitiveness, and we wanted to see savings across the board. These staggered approaches where we're seeing it benefit in one area and not in other has led to the recommendation for the committee that we place the business with Hartford. Although they have a modified open enrollment, that should cause stabilization of the rates whenever we go to bid again. We shouldn't see as drastic of an increase. It should stabilize our experience somewhat. And with the line of duty dismemberment being removed, we haven't had any claims in the last couple of years that I'm aware of. Are you aware of any, Ms. Anderson, as well? And she handles the actual life claims. So you have to figure they're only going to pay a certain percentage. If they lose, a portion of a digit, then it's going to pay whatever that number is. It's only doubling that piece. So it's a very small amount of money that would possibly be paid to that employee anyway for that piece. But if they do die in line of duty, then it pays that double indemnity, and it takes that $35,000 to $70,000. We do have MetLife and Hartford here today. If you'd like to ask them to approach so that we could answer any questions from them that you may have. But Mr. Brown is the broker on both of the bids, and he could answer questions as well.
Okay. Do you understand all of that? They are suggesting that MetLife and Hartford are the two finalists, and they both have savings. They're not equal savings between the county and the employees and their additional supplemental insurance, but in any event, it's a little bit more balanced with Hartford in that the county gets some savings and the employees as well, even though the total of those savings is a little less than the total for MetLife. So, Ms. Stinson, are you and Mr. Cowan recommending Hartford? Is that your first recommendation?
Yes, sir. The recommendation to the committee is that we accept the bid from Hartford.
Okay, you've heard this discussion. What other discovery do you need, or is anyone willing to make a motion? You have a question, Ms. Stevenson?
Are both of these plans portable for when they leave active employment and go to, they retire? Are both of these plans going to be portable that they could take the life insurance with them?
Yes, it's just like it is today.
Okay. And is there a cap on what a retiree can keep in insurance? I mean, is there a cap? Is it $10,000 is the max as a retiree, or is there a cap on that?
It reduces to $25,000 at age 65, and then just like with current at 70, the insurance terminates.
Okay.
Ms. Harvey.
Okay, so tell me again, you said that if they're currently having the life insurance and they can transfer over to the new policy and there's no pre-existing condition, it will not affect that. But if they do not have current life insurance and they go, then it's only $10,000 per year until they work up to the $30,000. Is that correct?
That's correct.
Other questions?
I'll make a motion to go with Hartford based on the recommendation of Ms. Stinson and Mr. Brown, based on the overall savings to the whole plan in general.
Second by Mr. Sandvig. Other discussion now? For the discussion, you're ready to vote. All of you in favor of that motion, please say aye. Aye. Are there any opposed? Okay, let the record reflect that was unanimous. Now let me see. Item number 6 is short-term disability. And Ms. Stinson, are you and Mr. Brown both again handling that?
Yes, I can speak to this one. On the short-term disability, if you refer to your document, obviously we look at are we replacing current benefits, because our intention is never to lose any of the benefits that we currently have today. And then secondly, we look at what is the rate to replace those benefits that we have today. Unfortunately, Reliance did not submit a bid to the purchasing committee by the deadline. Therefore, the incumbent is not a consideration in this bid process. Cigna proposed a flat premium, so the premium would remain the same, and they matched all benefits to the current Reliance carrier. The next bid that was the closest to our current would be MetLife with a 2% increase. However, we requested a 3-year rate guarantee. They only provided us with a 2-year rate guarantee. In addition, our current weekly maximum benefit is $1,250, and they lowered that weekly maximum benefit to $1,200. So in light of those two differences, we did not bring MetLife today as a finalist. We're only presenting Cigna as a finalist because the next in line, which would be considered, would be Hartford, but they have an 11% increase over our current cost. So recognizing that Cigna is replacing all existing benefits and that they are offering a flat increase in the renewal, then the recommendation to the committee is that we place the business with Cigna.
Okay, short-term disability, the recommendation is to accept the proposal from Cigna. Questions, or do we have a motion before questions?
I'll make a motion to approve.
You make a motion to approve the acceptance of the proposal from Cigna.
Yes, sir.
Do we have a second? Mr. Sandvig has seconded that motion. Now, any other discussion or questions? Okay, all of you in favor of that, please say aye. Aye. Any opposed? Okay, likewise, that is unanimous. Trust me, this is not going to go this fast on some of these others.
We appreciate your cooperation up to this point, though.
We appreciate your, yes. Let's see, property and casualty, and we're going to have some assistance from Mr. Shoup. And are you going to give us an overview of those bids, Mr. Shoup? Okay, come on forward. And do we have handouts or anything here?
Yes, sir, they're included in the packets. There is a document included in your packet titled Rutherford County and BOE 2013-14 Property Casualty TPA Executive Bid Summary, as well as a second document which is titled Rutherford County and BOE Property and Casualty TPA Bid Summary, and a third document which gives you a claims cost comparison. It is a colored sheet of paper, and that compares the actual cost of claims administration among the two TPAs being considered. So, Mr. Shoup, if you'd like to provide an overview.
Good afternoon. I'll begin with the executive summary, the 3-page document, and opening remarks just to give you a lay of the land and what you see in front of you. This is a reduced copy from an 11-page summary of the entire submission from everyone who participated in this process. There were 2 submissions. Among those 2 submissions, there were multiple carriers who came through those 2 brokers. So there were a lot of insurance carriers that participated, although there were only 2 brokers who funneled those into the process. J. Smith Lanier on the far right, one of those brokers, although there's only 1 submission here, they did send this out to multiple carriers, but they chose to only submit 1 of their proposals. CCMSI, the other broker, did submit through 3 of the carriers that they received quotes from. The far column to the left is who you're currently with, and your current carriers are through Great American and Travelers. Great American is the crime company, has the crime, Travelers the property, Inland Marine, and ACE has your casualty. And then CCMSI is the TPA, which handles your on-the-job injury occupational program. And the other companies that quoted, CCMSI quoted all of their property in Inland Marine through Travelers on all of their options. They did, however, give other options other than ACE on the casualty. They quoted also through Princeton and Brit Global. The J. Smith Lanier quotes came through Affiliated on the property, and then through Argonaut on the casualty. A couple of things I'd like to point out on page 1 that are different between the two submissions. On property, it says number 2 at the top on the far left, on the amount of coverage, we asked for $100 million blanket, which is what you currently have. J. Smith Lanier quoted $200 million. That's double what you currently have. It seems like a lot of difference, but on a blanket basis, that means you'd have to have over a $100 million claim for that to kick in. And although that's unlikely, it's still possible. So that is to their advantage that they quoted that. Also, and the reason that they said they quoted that was because it was the same price. On down under earthquake on number 20 on the left, they quoted a $100 million instead of $10 million. And again, I think that was for the same reason. It's noteworthy to point out the difference in the premium, and if you want to look at the far two right columns, J. Smith Lanier's $433,000 for that property, and the one next to it through Travelers at $435,223. The option 3 includes crime, and although that crime is through Brit, that's still about an $8,000 premium for the crime that is not included in that $433,000 under J. Smith Lanier. So there is quite a bit of difference there, so those premiums aren't as close as they appear.
If I could just interject for one moment, because I want to make sure we don't lose sight of what was just said. As we asked for all lines of coverage to be quoted, J. Smith Lanier did not provide a quote for our crime. Now, they have indicated that they could accept a broker of record letter and acquire the business, but their quote does not include a quote for the crime insurance, which is what Mr. Shoup is saying, and he is saying that the amount of that premium equates to about $8,000. So you would have to assume that if they were able to quote it, that it would have been $433,000 plus the $8,000 that is missing because they did not quote the crime. I'm sorry, you go ahead, Mr. Shoup.
If you look on down that page under bid specifications, inland marine, another notable difference on item 4 to the left, coverage to apply on a blanket basis. All of the CCMSI quotes answer yes. Under the J. Smith Lanier, it is per schedule.
Provide an example of what inland marine covers.
Yes, if you look down at the next to last two lines, 2 of those are broken out there. Contractors' equipment, which is smaller pieces of equipment, backhoes, things that your highway department would use, things that are used in maintenance at the schools, and also musical instruments, large instruments that are used in the band, are broken out. There's $1,600,000, for instance, in the schools. And what this is saying is that we want those on a blanket basis, so we don't have to run around every week and make sure that every one of those is listed. And we've got the serial number and the model number and so forth, so we don't have to keep up with that on a daily basis. That's a blanket basis. What the other company is saying is they have to be scheduled. If they're not on the schedule, they're not covered. So that is a significant difference in coverage form. Wanted to point that out. If you look on page 2, at the top, now we're on talking about vehicle insurance. Under physical damage, that's the damage to your vehicle. We ask for $1 million limit with a $25,000 retention or deductible. In other words, you pay the first $25,000. CCMSI said, yes, that's the coverage we're offering. J. Smith Lanier, the lowest retention they could get is $50,000. So it's twice what we ask for. So you're responsible for $50,000 instead of $25,000 under their quotes. Now, to their advantage, their quotes on the liability portion of that, you have a $5 million limit of liability. What their carriers did was to write $1 million basic with a $4 million excess, and they do it on each line. What we have had in the past is just an overall blanket of $5 million worth of coverage for auto liability, general liability, law enforcement, school, E&O, all of these coverages that we have. What they've done is give you $5 million for vehicle, $5 million for general liability, $5 million for law, $5 million for school, and so forth. So aggregate-wise, that's a lot more coverage by piece. And why that's important is that when you use up $5 million of aggregate, you have no more insurance. That's all you have. That's the bucket. So they have provided multiple buckets of that, so to speak, to give you that coverage. So that is a difference in form in the way they are offering their coverage. Another notable thing, and I may ask Ms. Stinson to comment on this because I have not been involved in your program the past few years. We have had an issue come up on uninsured motorists regarding your contracted school buses.
Yes, that's correct. I've met with the Board of Ed a couple of times regarding the bus contracts because they are in negotiation with contracted bus drivers. And Mr. Sandvig, please feel free to interject. And one of the things that has come to the table is coverage for uninsured or underinsured motorists for our contracted school buses. It's been explained to me that the cost associated with a contracted school bus owner obtaining the uninsured motorist or underinsured motorist coverage is a very high dollar amount. If it is required of the Board of Ed to help fund that, it will come at a great cost. And it also makes it difficult for Mr. Snell from a perspective of having someone come in and substitute a school bus, because then, much like the issue with making sure that every musical instrument is on a schedule, they will want to know at the individual carrier for that bus coverage who all could possibly be driving the bus, and you may not know if you have to call a substitute in. So they requested that we obtain coverage for UM through our group policy, and we requested that as an addendum to our bid. The responses that we got from CMSI indicated that it would be added, no premium with ACE, and I can't recall on the other ones off the top of my head, but with J. Smith Lanier, in some instances there would be additional premium for that coverage, and in other instances they considered that vicarious coverage, which means that it would fall under the general liability aspect of our insurance, and we had insurance already. Now, why it is important is because currently a child who is on a school bus and that school bus has an accident has no means of recourse, because if the third party is an uninsured motorist. Our contract currently excludes that type of coverage on that contracted school bus, and currently the contracted school bus does not have that type of coverage. So this really would close a gap in the program in the event that a school bus was involved in an accident and a child or non-employee was injured on the bus. Is that stated correctly, Mr. Sandvig? Okay.
Ms., what line item are you on page 2 there? I mean, I see.
You're on line item number 3, the 4th, where it says $500,000 hired and non-owned is right below it, and above that it says $500,000 uninsured, underinsured motorists.
So the difference here is J. Smith Lanier has said, I have to look at those lines to be sure.
They've said no.
Said no. It says they have not included it.
They have not, and they are saying for 2 different reasons. One, because it would either require an additional premium, which we just received that information today after our interview with them, and even then that wouldn't be a guarantee that they would write it as it stands today because they need more underwriting information. And then with our other carriers that they brought to the table, it's assumed as vicarious liability, and there would be coverage in that particular instance.
Mr. Sandvig?
Were you satisfied with that, Mr. Shoup or Ms. Stinson, the vicarious coverage as it was explained in that meeting.
You want to respond first, Mr. Shoup?
Yes, I was. And as has also been pointed out, if the county is sued, there is a tort limit. Now, your attorney would need to look at that because under the state tort cap, there are some exceptions dealing with transportation. So you'd have to be clear on if that was an exception, but whether or not you're limited to $350,000 or if the sky's the limit, but still yet, we need to make sure that the county is protected here under whatever.
Yes, I think that the vicarious liability provision that they discussed is adequate. Our problem today is that it's specifically spelled as an exclusion. And so in the absence of that exclusion, we would have an argument to the vicarious liability, but they're willing to put it in as an accepted risk with CCMSI. So that would just clarify that much further. Okay, go ahead, Mr. Shoup.
About 2/3 of the way down,
Mr. Shoup, before you go that far, what I have labeled with the number 13 out beside it, what's this additional amount of money? J. Smith Lanier has a $27,968, where they're on the other side over there for CCMSI says included. What is that about?
That premium is noted again on the next page. That is a confusing bit of premium, and it deals with J. Smith Lanier quoted the auto physical damage two different ways. They quoted it in the inland marine and they quoted it in the excess liability, and it depends on where you put it as to where you have to put it in or take it out of the premium. And so you'll see on the next page where that comes in. The other thing is whether you're covering the vehicles while they're parked or whether they're on the road. And I think you've had a claim in the past that dealt with that very issue with some hail. So that becomes a real issue. So that's what the asterisk.
So the asterisk is shows a plus 27,000 there and a subtracted 27. So is it a net zero? It's just the way you've reported this?
Yes, sir. On the next page, you'll see it's in parentheses, which actually it gets taken back out. So
there's no additional premium here from J. Smith Lanier. It's just the way they reported it.
Correct.
Okay, thank you.
And on down on number 15, where we talk about the premium for this coverage is, you'll see two premiums there, and one says with APD and without APD, and that's precisely what we're talking about, whether you put that auto physical damage in or you take it out. So that's the difference. But I do have a summary on the next page. This is actually a reduction of the individual pieces. At the bottom of this second page, we ask for all of this to be net of commissions from the agent or broker, and in lieu of that, for them to give us a flat fee. And CCMSI quoted a $10,000 fee, and J. Smith Lanier quoted a $60,000 fee.
And who pays that fee?
Rutherford County.
Okay.
And that would be in addition to any other costs that you have. On page 3, we get into the TPA services. This gets really detailed. Mainly want to point out that CCMSI, as far as processing both on-the-job injury claims and property and casualty claims, probably has the most experience, in particular with public entity, in doing these kinds of services over Brentwood Services. Brentwood Services, in fact, was your TPA when you were self-funded with workers' compensation prior to going to OJI, so you have experience with Brentwood Services. But CCMSI took over when you opted out of workers' compensation several years ago and has been processing the on-the-job injury, which is a much different program. And so they do have more experience in that. Now, if we could, before we go to these other totals, if I could get you to look at these other two sheets briefly, it'll help the totals make more sense, I think. If you'd first look at the one called 2013-14 TPA bid summary, this single sheet. Incidentally, J. Smith Lanier quoted two TPAs. They recommended Brentwood Services. We agree, of the two they submitted, this was the better choice. And if you look down those two columns and comparing these two, they go back and forth as to who has a better per claim rate for various types of claims. Then if you look at the takeover, if you do change and go to Brentwood Services, for those claims that have already been incurred, you're going to incur another charge for those again to take them over and set them up. And that's what the middle bracket is for, is the additional charge. There would be a one-time conversion fee that you would incur of $3,500 for that. And then there are some other charges, administrative charges down below that. And again, there are some charge more, some charges are less. The one thing that Brentwood did offer, excuse me, that CCMSI did not, was a flat fee of $110,000 with a minimum of $85,000. Now, with that in mind, and by the way, CCMSI's minimum charge is $9,950. If you had no claims at all, you still would pay $99.50. And with Brentwood, if you had no claims at all, you would pay $85,000. Now, if you look at the second TPA sheet, I think yours has color on it as well. What we did to try to figure out this total cost, we had CCMSI give us a period. In this case, it's from 2011 to 2012 fiscal year, a total claim count. And then what we did was to take the rates from this other sheet and apply it to actual claims counts and come up with what you actually paid, and then find out what would have been the difference had you been with Brentwood instead of who you were with. And you'll see at the bottom, I subtracted that for you, and it would have cost you $2,420 less had you been with Brentwood over using these actual claims. So in reality, there wouldn't have been a great deal of difference in cost had you been with the other TPA.
That $177,000, that doesn't include the cost for the takeover of existing claims. Is that correct?
That is correct. That's just actual claims.
That's just actual claims projected.
Now, if you go back to the previous document we were looking at on page 3, the good news is that your cost for these coverages is going to go down over what you paid last year. The first column to the left is your current program and costs. And you'll note that your property, in the current year, $398,000. And we are looking at the option 3, which would have been the Travelers property and the Brit Global casualty. That property program is $435,223 compared to $398,780. You have had increased in exposures. You've added more property. The cost of your property has gone up. So that accounts for probably almost all of that increase in property. But if you look down at your casualty line, last year was 709,500, and the Brick Global's coming in at 604,800. And you can look over at the quote from J. Smith at 654,375. And there's also a difference between the broker fee as well. And as we said, the TPA services in actual cost would be about the same, plus you're going to incur a cost of takeover, which would be additional cost if you go there. The one thing about the numbers, this year you do not carry terrorism coverage. If these numbers do have terrorism included, the reason for that is the J. Smith Lanier quotes had the terrorism included, and I didn't know how to break it out, so I had to include the other to get them apples to apples. Now, I can tell you that the CCMSI quotes the terrorism on the property is around $2,000, and about $5,200, so there's about $5,400 worth of terrorism premium in the CCMSI quote. If you choose not to take that, that would be backed out of there. Depending on what you can decide if you want that or not. But that is included in these numbers. And I would have to assume it's about the same amount in the J. Smith Lanier number as well. Any other questions? Yes, sir.
Under the TPA services, did I understand this properly? We could opt to pay the $110,000
That's correct.
flat fee.
Yes, flat fee.
Under the J. Smith Lanier.
Right, that's correct.
Other questions, Ms. Harvey?
So on this insurance that we're looking at, if we have a major claim, is that paying the cost to replace that equipment, that structure or whatever, or is it the value of the time? Like if you have a 2010 model or equipment, computers or whatever, is that paying for that 2010 cost, or is it going to pay for what it costs now to replace them?
If you're talking about equipment, it should be replacement cost. If you're talking about a vehicle, it's going to be actual cash value. Okay?
The actual cash value of what that car is worth, depend on years, mileage, those type of things.
How it is today as well.
And your rating is reduced for that. They take what you paid for it and the age of the vehicle, and that's how the rating is reduced based on that. So you don't continually be charged for a brand new car or bus or whatever.
I do want to advise the committee that unlike with the other bids, we do have both CCMSI and J. Smith Lanier who will provide a 15-minute presentation today as well.
Ms. Stevenson?
I had a couple of questions along the lines of what Ms. Harvey just asked. If you look on your first page under the bid specifications under computer, item 4, it says replacement cost of coverage will apply. And the first 3 options say yes, and the last says no. So I just want clarification along with that. What you just said, it would be replaced at what it would cost to do it today. What does the no mean, I guess is what I'm asking.
Well, under J. Smith Lanier, we had asked them that, and they had replied that it was it would be replacement cost, but it was.
So if a computer costs less today than what they purchased it at 3 years ago, it would, if they originally purchased it for $1,000, but you can buy that same computer today or equipment for $700 today, it's the $700. Was that not the example they gave?
Functional replacement cost.
Right.
I think that's the term that was used.
Right, that's correct, functional.
Replacement cost.
Okay, and then on the second page, Item Z, under bid specifications, it says elimination of all sidetrack exclusions regarding work 50 feet from railroad. And then you have a no with an asterisk on J. Smith Lanier. What does that mean?
Well, actually, all of those are no. We did that to point out to the county that you do not have coverage for that. And just briefly, any work that's being done within 50 feet of a railroad, you do not have any coverage for that. And normally a railroad will offer a policy. This is very typical. They'll offer, like your highway department or someone, a policy that you buy just for a period of time, the period that you're doing the construction to get that done. We have got some insurance companies to pull that exclusion out of the policy so you don't have to buy that from the railroad. But a lot of insureds don't even know that that exclusion is in there. But it's important that you know that that's there.
Two more questions. Then on page 3, where it says number of years the TPA has been paying claims under the OJI program, under J. Smith Lanier, it says since 2007. What other public entities do they have, or do you know?
I don't know, did they bring BSO?
I don't know if, wait a minute, I may have that here. They have City of Murfreesboro. Now, I don't know if these are OJI.
No, these are for BSI. She's asking for Brentwood Services.
Oh, I do not have that.
Gwinnett County Public Schools, University of Alabama, Birmingham, Drummond Company, City of Huntsville, City of Jackson, Tennessee, City of Auburn, Sevier County, Blount County. They have a county in North Carolina, Birmingham, Alabama, and Waffle House is some of the ones that they referenced to us.
And all of those are on the OJI program.
They did not distinguish that. We can tell you that when we were with Brentwood Services and we made the move, there was not a support for the OJI program at that time with Brentwood Services. They have since revisited their position, and only in the last, I believe, 5+ years was what was given. So if they're here today, they can speak to that better, but their experience with OJI is not to the extent of CCMSI, is my understanding. One other thing that I did want to point out we haven't talked about yet is the vacancy provision. A vacancy provision says that once a building sits empty for 60 days, at that point it doesn't have full coverage anymore. It has actual cash value. So we have an older building somewhere that sits empty. After 60 days, it's not replacement cost. If a tornado blows it down, it was actual cash value at the time of the damage. So that is a difference with J. Smith Lanier as well.
Last question I have is on the broker services, where we're currently paying the $10,000 and theirs is $60,000. That is in addition to whatever that, whether it's $85,000 or the $110,000 fee, correct?
That's only with regard to their broker services. Are there any other questions of Mr. Shute? Okay.
Okay, thank you, Mr. Shute.
We'll have Jason Lanier come first.
Okay, so what we're going to have now, they're going to have 15 minutes to...
I'm sorry, Mr. Hall.
One more question, excuse me there, Mr. Hall.
I'm sorry. I was just going to ask real quick about the, Jeff, I was just going to ask, I just happened to think about it. What is the minimum liability for a school bus for a contract, to get their contract? Do you remember? Is $1 million, and then this would be $5 million on top of, okay, whatever that is. And then the second thing I was wondering was, how would it play out differently? I was looking at 9 and then J, K, and L underneath that right there, where the $1 million plus $4 million excess. How would that play out differently? Let's say a public official claim or something like that. How would that help or hurt in a situation that you could put it in where we have a person, a public official, whatever it is, you know what I'm talking about, get some kind of an issue where that would change the way it is that we have it now?
Theoretically, if you had a public official got into and a claim was settled and at $2 million, and that erodes $2 million out of your fund of $5 million, you only have 3 left. But the way the other is set up on an individual line of insurance. You have $3 million left on public officials. You still have 5 on vehicle, 5 on general liability, and so forth. Okay.
Okay, thank you, sir. Maybe some other questions later. So we're going to give J. Smith Lanier and CMSI an opportunity to make their presentation. We're going to give them 15 minutes.
Yes, sir, we're going to ask J. Smith Lanier to come first.
Okay. So someone is getting J. Smith Lanier to come in first and make their presentation.
Yes, sir. Ms. Perrin's going to get him.
Are we going to let them ask them questions if we want to? Is that in their 15 minutes?
Maybe 15 minutes to talk.
To talk, okay. Then we can ask questions if they choose that.
Yes, sir.
Which one of these, who are these folks? I didn't know. The last one is Chip, who are the third one?
Yeah, so that's
Chip.
Chuck Anchors, Josh Roden is the... If we could get you all to come up to the podium, please, for
Come on
presentation.
up here first. We're going to give you your opportunity to. Okay, you can introduce your group and tell us who you are, and you can speak for up to 15 minutes or whatever you choose to tell us about your proposal.
My name is Chuck Akers with J. Smith Lanier and Company, and we thank you for the opportunity to be here today to talk about our broker services, our insurance program, and our third-party administration. We're going to probably split this up into about four categories. I'd like for Chip just to give you a little background on J. Smith Lanier and Company. I will tell you a little bit about what we did through the process. Josh is our Director of Loss Control, and he's going to tell you a little bit about some of the services that our agency provides beyond placement of insurance. And then John will tell you a little bit about third-party administration for Brentwood Services. So if Chip can give a quick overview of J. Smith Lanier.
Good afternoon. Thank you all for having us. Chuck and I, and Josh Broadus is with us today as well. We are with a firm by the name of J. Smith Lanier and Company. We are located here in Murfreesboro, Tennessee, Church Street in the TDK building. We are a privately held insurance brokerage firm founded in 1868. We have 19 offices across the southeast. In Tennessee, we have Knoxville, Chattanooga, and Murfreesboro. Chuck and I manage the Murfreesboro office together. We are both from Rutherford County, born and bred, and choose to live here and raise our family here. When the bid was solicited, we decided to respond. We have a municipality division within Tennessee. We have a strong understanding of municipality and public entity insurance programs. And together with the assistance of Josh Broadus, and I know Chuck will go into a little bit of detail of what Josh does, but ultimately we have a risk management program besides just the product and placement of the insurance coverage itself. But again, J. Smith Lanier is a privately held insurance brokerage firm that operates within Tennessee and in Rutherford County. We appreciate your opportunity. Thanks.
Just real quick, we sent the insurance out to bid to the marketplace, and we are the middle man between that process. So we represent the county in terms of its best interest to the marketplace. The current program that the county is with is Travelers and ACE, and we're very familiar with Travelers and ACE. I think we have about $40 million in premium volume with Travelers. We're the largest broker in the Southeast with Travelers. So we could not solicit bids from current carriers because there's already a broker on that. That being said, our recommendation that we came back with was Affiliated FM. Affiliated FM is a property-only market. They do write a lot of municipality business, a lot of large property schedule business, which Rutherford County obviously has. Alteris was the recommendation from the carriers that we could solicit bids from on the casualty lines. Alteris is very familiar with Rutherford County. The underwriter that worked on the account used to insure Rutherford County 7+ years ago before the ACE program took over. We have a marketing department that goes through that entire process. We analyze the current Travelers program with the current the Alteris quote that we had, and as Chip said earlier, and has said in previous meetings, our services are obviously independent of the insurance company at J. Smith Lanier. Our services are independent of the third-party administrator as well. So any quotes, any bids, whether it's Travelers, ACE, Alteris, FM, Chartis, any number of carriers, J. Smith Lanier can be your broker and offer the services that we potentially provide. Josh is going to talk about a little bit of those services, but I'll give you an overview of two very quick. Marketing was handled by Trish Gunning out of our Chattanooga office. Trish, again, goes to the marketplace. She analyzes programs. She comes back with options. And then we bring that to the clientele and say, hey, based on the number of carriers or the number of programs we got back, we feel like this is the best option. So Trish did a phenomenal job in that and pointing out the pros and cons with the Alteris program and the ACE program. Trish also has a great relationship with the marketplace. One of the things that J. Smith Lanier has is they have market clout. We're the largest privately held brokerage company in the Southeast, so we do have volume with insurance carriers, and we have great relationships with those carriers. So Trish is kind of that intermediary, as Chip and I are, between the marketplace, the broker, and the clientele. And again, we represent all of them. So for the fee for broker services that we've provided, we can service any account. Claims is the other division that we have within J. Smith Lanier that is a big service area. Jerry Hedgepath was in this Monday. Jerry handles our claims service. Rutherford County would utilize J. Smith Lanier's claims service, as well as Brentwood Services third-party administration claim service, or any other third-party administrator. And Josh, real quick, will just give an idea of some loss control services that we provide from J. Smith Lanier.
Thank you, Chuck. I'd like to start off just real quick and brief little history about myself and J. Smith Lanier. Lived here in Murfreesboro in 2002 when my wife and I got married. I was actually on the carrier side and sought out J. Smith Lanier for the position that I now have. And they asked me to move to Huntsville. And the timing became right when Chip and Chuck had the office here in Murfreesboro, and we joined forces. I asked to move back. So once again, live in Murfreesboro by choice. So very thankful to be here. I do manage our risk control department. There are 6 of us spread throughout the offices that J. Smith Lanier has, which is from Lexington, Kentucky, down to Tallahassee, Florida. I live on just up off of Church Street on Indian Hills, or in Indian Hills neighborhood. The services we provide vary greatly for each account. I've been doing some services for the city of Murfreesboro. Did a employee safety perception survey, and also did a OSHA 10-hour class for them. These are all value-added services. Everything I do for my accounts is free of charge, or is part of the services with the program. What I would envision for service for Rutherford County would depend on what the decision makers would like me to do. I don't take any cookie-cutter approach to service. What I would do is sit down, look at the losses, and I would propose ideas for action plans for reducing those losses. And it may include some safety assessments. It may include some driver training, defensive driving. There's a wide variety of resources available. We also have a lot of resources, including safety videos, a video lending library, online safety training. We partner with the carriers. Most of my accounts like me to quarterback, if you will, the loss control services that the carriers provide. That way we're servicing you all with a unified approach, and then I also make sure that the carriers we're fully utilizing their services when it comes to loss control, and not just coming out and doing underwriting surveys. So ultimately my goal with each service account and with Rutherford County would be to reduce your overall cost of risk. And I'm available at all hours of the day. I've got accounts in California that get immediate response when they email me at 10 o'clock on a Friday night. So I'm fully accessible, live here, and look forward to working with the county. Thank you.
Hi there. I'm John Smitherman. I'm with Brentwood Services Administrators. I'll just try to give you 5 minutes on a little bit about who we are and our history. You may remember that Brentwood Services handled your claims about 5 years ago, and There have been a lot of changes at Brentwood Services since that time, so I wanted to kind of cover some of those as well. But Brentwood Services is based in Brentwood, Tennessee. We've got 5 offices, about 175 employees. We're privately held, and we're employee-owned. So the employees own almost half of the company. So I think that helps us as far as dedication. The employees, I think and act like owners. And I think it helps us with the turnover as well. We don't have a lot of adjuster turnover, and that can be key when it comes to managing your claims. We specialize in managing claims for self-insurers, insurance companies, and self-insured groups. And 5 years ago, we really specialized in workers' comp only. We didn't have a lot of expertise with OJI programs or general liability and property claims. And since that time, we've developed a dedicated general liability and property claims unit, as well as several OJI clients, some of those being UAB down in Birmingham, the city of Jackson, Madison County, and Lawrence County. We also work with Knox County and Warren County as well. One of the things that we offer is we offer access to everything that we do through our system. And I think the nice thing about being local is you can rest assured that you have access to the senior management of the company. I mean, I'm part of the sales team, but I'm the guy that's going to take care of the problems. I'm not just going to, convince you to work with us and then walk away. So I'm the fix-it guy, so I'm the one telling you about us today, and I'm also the one that's going to take care of things. Another thing that I think is important to know is we believe in service. We have a live person to answer the phone. So, your claimants or your department heads, they're not going to call and get just a voice. I like to call it voice jail. They're going to get a live person. They're going to be able to get to their adjuster, and all of our adjusters have backup adjusters as well. And again, I think there's a lot of value in the fact that we are just in the county next door. I found out this morning that we have 17 employees that work for us that actually live in Rutherford County. And I wanted to mention just a few of the names of the clients that we work with you might have heard of. Lifeway Christian Resources. We handle all claims for Waffle House. That's property, general liability, and workers' compensation in 10 states. Baptist Memorial Healthcare Corporation, Eastman Chemical, and the following associations, the Home Builders, Road Builders, Auto Dealers, and the Associated General Contractors. And we've actually won awards for our service. One of our largest accounts, Eastman Chemical, last year, they work with 6,000 vendors, and they awarded us one of their Excellence Awards for service. They only handed out 20 of those awards, and we received one of those. And I've got a copy of that letter if you'd like to see that. But it would be an honor to have the chance to work with Rutherford County again, so we certainly appreciate your consideration.
Just real quick in closing, once again, Chip and I and Josh and John, thanks for the opportunity just to come present in front of Rutherford County. We do feel like the program that we offered from a coverage standpoint well exceeds the current or expiring program. Not real sure about the renewal with the Travelers carrier or the ACE carrier, but again, as we stated and have communicated, we are a broker. And from the service standpoint, we can do anything in the middle that any vendor has brought to the table. We just, again, thank you for the opportunity. I do have a proposal that we printed out that gives a summary of that, but I know that Bob provided some of those coverage differences as well. So I will hold on to that. And just like John said, if you do want any copies or further copies, we have plenty. So thanks for the time.
While they are here, does anyone have any specific questions they'd like to ask them?
Questions we asked about the OJR program. Do you currently have anybody that you're servicing in any municipalities that are on the OJR program?
Yes, we do. City of Jackson, Madison County, those are, of course, both in Tennessee, and then UAB in Birmingham. That's probably our different states. Their benefit plans are virtually identical.
Does anyone?
Also Lawrence County too.
Anyone else want to ask them a question while they're in here? Okay, well, we thank you, Chuck, and your team for coming and presenting and making this proposal. Thank you very much. Okay, next proposer and presenter will be CCMSI. Come on aboard, Janet. Now, Ms. Bowman is with CCMSI, and you're a team of one. Is that correct today? Okay. So you have 15 minutes to tell this group all about your company and about your proposal, and so have at it.
Burgess. I appreciate being able to be back in front of the board, and I've got a handout if that's okay.
We'll take care of that so you can continue speaking.
As most of you know, we are the current broker and third-party administrator, and I appreciate, like I said, the opportunity to be here. We had presented, and I know that Mr. Sheep has probably gone over the proposals with you, we have presented 5 different quotes this time around, and the good news is that regardless of what coverage you went with our package, if you choose to do so, you're going to be saving off the expiring premium. So that's the good news right off the bat. What I did is I tried to just simplify that. I'm sure like I said, Mr. Sheep, since he's your hired consultant, probably provided a greater detail of the program and premiums, but I just thought I would kind of break down the 3 options that we're bringing forth and kind of tell you my opinion on each one of those. The first option is your current carrier is Travelers on the property, ACE on the casualty or liability, which includes everything from your general liability, auto physical damage, law enforcement, public officials liability, school board legal liability, pretty much anything that is not property or crime. And then your current crime carrier is Great American. You'll see the limits there in the center column, and then the premiums in the purple, with the loss control discount being given by ACE, which they have done for several years in a row. Y'all have actually been with ACE since 2007. CCMSI, of course, actually, personally, I have been on the account for over 20 years, and so I take great pride. And I said to somebody the other day, actually, I've been in Rutherford County longer than one of my children has been alive, so it's very passionate to me. You'll look at the total cost there if you were to take the coverages with your same carrier, and again, that's a savings from the previous year. Then the second option is Travelers, again, on the property. Most of you probably are familiar with Travelers. They are a very strong property market. They came in several years ago when Allianz had non-renewed and kind of pulled back from the public entity sector, and Travelers came in and wrote the coverage, and they paid on several fire losses in this past year. Then we look at Princeton. Princeton is a carrier that we have, and they are on a lot of Tennessee business. They insure Williamson County and Williamson County Board of Education, Sullivan County Board of Education, the town of Smyrna. And so we do a lot of work with Princeton as well. Very strong A+ 15 rated company, and you'll see that their premium is going to be actually lower than the current ACE and Great American. The difference there is Princeton includes the crime coverage in with their quote, where the option 1 actually is a separate company with Great American. With that being said, I will say that Great American has been on your account for over 20 years as well. The third option is with Travelers on the property, and then Brit Global. on the liability and casualty. Basically, Brit Global, and they do a lot of governmental entities as well. They are a strict excess liability carrier. They are coming in offering a little bit more coverage. They're offering the $5 million per occurrence, but they're also offering a $10 million aggregate. The difference there too is that on the third option, the Brit market is not actually combining the general liability and the law enforcement. ACE and Princeton combine those coverages. Brit actually separates those coverage. So the law enforcement would have their own separate limit and their own separate aggregate, which is not that we've ever gotten close to that, thank goodness for that, but that's just something that I wanted to make sure that I pointed out to you. They also include loss control services. The carrier does from their standpoint. They have several online programs that you can be a part of. They also offer a really nice type of program for law enforcement. So that is included in the option 3 quote as well. You'll notice that they are they're roughly $70,000 lower than the first quote. And again, they are an A+15 carrier as well. Like I said, we have had the luxury of, I personally have had the luxury of serving Rutherford County here, and just like anything else, I'm sure that there's always been ups and downs, as there is with anything that you do, but I can assure you that we are committed to providing and continuing to provide, if you choose for us to do so, the services and anything that we've done or anything that you would like for us to do different, we were most definitely would adhere to what you would like for us to do. I'll be glad to field any questions if there's any questions.
I have one I'd like to begin with. Could you clarify, just so that it's stated, on the UM coverage, can you elaborate on the carriers?
Ms. Stinson and I had met back with the school board a couple of times, and I know that that's been a concern as to the uninsured motorist. ACE would provide uninsured motorists and underinsured motorists at $1 million limit with the same retention. And then Princeton and Brit Global would also provide the $1 million limit. It's included in their quote. If you want $5 million to match the current, then it would be an additional charge. But all three carriers are providing the uninsured and underinsured motorist coverage in their quotes.
Questions? Mr. Sandvig.
Ms. Bowman, do you have any feel for what that
what the additional premium would? It would be probably roughly around $5,000. Typically, when you're looking at uninsured and underinsured motorists, you're going to be protected still by the Tort Liability Act, and of course the insurance company would want to defend tort liability. And while we would want to protect, in this case, the children that would be on the bus, normally is what we're looking at protecting, we also want to make sure that we protect the county and school board as well. So yes.
Anyone else have any questions of Ms. Bowman? Okay, thank you very much. We appreciate it. Ms. Stinson and Mr. Shoup are still there. On page 2 of your summary, Mr. Shoup, the premium for the commercial general liability is, on option 3 for her, is $604,800 on your sheet. On her sheet, it's $593,000. Is that? Am I missing something there?
Could we ask Mr. Shoup to come to the podium, please?
Mr. Shoup, please come forward.
Which sheet are you looking at? Which number?
This one right here.
Oh, okay.
The 593, and you have 604,800 right there.
seen her.
You haven't seen her sheet. Here you go. Option 3.
I've got this.
For the 433 guys.
Is it the way you combine the numbers, Mr. Shute?
Yeah, I don't know if she's got the terrorism in there. I added the terrorism into
You
the
added
numbers.
terrorism into your numbers, and that may not be included in hers.
Right.
Okay, well, it's 7,
What was my number 6?
11,000.
It was $5,400 on, what's the difference? What did I have, 604?
604,800.
4,800. It's about $5,000. Did you include that $5 million limit cost?
No, but
Okay.
if there's about 5,000 difference, it's probably
It's-
terrorism.
It may be this loss control as well.
Okay.
The way that, because she shows the loss control as an offset.
It may be insignificant, it just, as long as we got the same apples to apples.
Okay, so you're saying it's the terrorism cost and the way that it's shown on yours versus hers?
Yes, 'cause
Okay.
my sheet is a total of all costs.
All costs. Okay, thank you. Now, so any other questions for Mr. Shute while we've got him up here again? All right, then we will, how are we going to proceed with this, Ms. Stinson?
So I just would like to summarize before a vote is taken. J. Smith Lanier is similar but different from CCMSI. There is an aspect of CCMSI, which is the brokerage. Janet performs that function in terms of she goes out and she obtains the coverage limits. The piece that we would pick up with J. Smith Lanier that CCMSI will provide upon request, but there is this separated person, which is Josh Broden with J. Smith Lanier, is the loss control. So that would be an extension of our current safety and training person in our office. They could come help do some loss prevention and loss control type work for us. Now, whether or not that plus their services is worth an additional $50,000 a year, you really would know until you actually were in a relationship with them. The issue that we see of them not being able to place all lines of coverage, that's not really that uncommon of an issue. And in some instances, they said during their interview that the reason they didn't present a quote was because it was higher and we were best suited where we were, so they did not include it in their bid. But they could obtain it through a broker of record. When I look at where we are today, plus the additional costs on the TPA side for a takeover situation, the premiums attached, it appears that the overall best option is to remain with CCMSI. Their costs are lower. We understand, we don't understand truly whether or not at this point the $50,000 difference on the brokerage would be worth it or not. I can tell you that Chip and Chuck have been making themselves well known to me as I round out 2 years here with the Rutherford County. They're very anxious to get our business. But nonetheless, I don't think that we've had any service problems or any other gaps in our relationship with CCMSI that would warrant a move just from that perspective. So all things considered, it appears that CCMSI would be the best bid for consideration of the business. And that would be using their Travelers and Brit Global recommendation that they provided, because those are the cheapest from a cost perspective in terms of our line of coverage.
Okay, do we have a second? Who was that? Did anybody second the motion? All right, Mr. Gammon. Now discussion. Ms. Stinson, go back a little bit and review this. We had a piece of paper that showed us the difference in the per unit, cost that would be accumulated, 180,000 versus 178. So those numbers were basically the same, right, from both of them if we use that. But we have this minimum, this all-inclusive number of what did they quote?
110,000 flat fee.
110,000.
Right, so you can look there and say it's 180,000. They would have only charged us 110 if we were in a flat fee arrangement. So there's a $70,000 difference there.
Now, there was, and I haven't found it again, but there was a 60,000 something that,
Right.
what was that about? I can't remember.
So the $60,000 is purely for, with the exception of Mr. Smitherman, who stood up here to represent the TPA, the services of J. Smith Lanier. So the services that the other three individuals talked about.
All right,
so that's pure brokerage. That is to secure our business, to provide us with some loss control services, and then to assist in the management of the TPA.
So we're out 110,000 plus 60, 170,000 for their services versus 180 for CCMSI.
Plus the 10,000 they charge
Plus
us for
10.
account management. And then you have the difference in the actual cost of the insurance itself.
So we're, J. Smith Lanier is 20,000 less, plus we have some additional costs for insurance, the $8,000 that wasn't quoted for crime, et cetera. So we wound up almost same money.
Correct.
Ms. Harvey.
On the J. Smith Lanier, they're providing more insurance per line, like the schools would have $1 million plus $4 million excess in that line, and then it seems like the different areas would have that individual pocket of money per line, where the MSI does not do that.
That's correct. They provide, one of the biggest advantages to them is it's $5 million per line of coverage as opposed to an aggregate. But when you look at our experience, how many times have we neared the aggregate? And so is it a real advantage for higher cost?
And it's across the various lines, property, and in casualty, and what else?
Inland marine, law enforcement. The other line of coverage they didn't place was our accident coverage, which is important to the two gentlemen on our committee. Our first responders, our firemen, our one county fireman, and our police officers. We have for the volunteers, we have a separate policy for them, and we didn't secure coverage through J. Smith Lanier with them as well. That doesn't mean they couldn't write a broker record, because they could, and they could obtain the coverage.
Okay, and Mr. Sandvik?
Like Ms. Harvey, I realize it is unlikely that we would hit our $100 million level. I do see some comfort in going to 2 in case we had a tornado like hit Joplin, Missouri, or taking out. We could theoretically hit that. I'm more concerned or more interested in having the $5 million coverage in several different areas in case we had, yes, hopefully we never will, but with the rates being that close, I see some positive sides to the J. Smith Lanier bid.
Yeah, I think that there's positives to both. I'm not indicating that J. Smith Lanier doesn't have any advantages, because I certainly do see those as well. But if we move to J. Smith Lanier, one of the downsides I would say is the experience on the OJI program. We're looking at an organization that has 5 years of experience versus an organization that we deal with now. There's additional cost in there, like for our case management, that's not calculated in. I think that the possibility of those advantages compared to the reality of what we know today, it still persuades me to make the recommendation to stay with CCMSI. We would have, but I'm talking about the cost. So when you look at the claims cost, if you go to that third or second page it is in your document, there's not a calculation for that as well. And if you look, like our case management hourly cost is $75 per visit, $40 per task, where it's $85 per visit for Brentwood Services. For utilization review, it's 100 versus 110. So there's some other numbers in there that would, that add up as well.
Mr. Hall.
I was going to ask, and then also about the per schedule in there. I'm kind of like you. I like this the $5 million, the extra coverage, but I was curious about the at a school. Say we did have a tornado and a school does everybody do an inventory at the beginning of the year of every piece of equipment? And that's renewed every time something's purchased, or is that?
But in the reality of it is that schedule is only updated once a year. So we really can't, and correct me if I'm wrong, but we can't count today for every tuba in every school that it's immediately added to the inventory list, which is immediately uploaded to the insurance carrier, which is why that blanket coverage is important to us. It may be added internally to the inventory list based on the tag process that he described, but we are not continually updating the insurance. That really happens once a year. So there is some exposure under that scheduled basis as well.
Mr. Hester.
On page 3 of the handout, looking at the $110,000 minimum fee, or is that a flat fee? In other words, this says for all services, including property casualty and OJI. So if this includes regular services,
On the TPA services, is that what you're referring to, Mr. Hester?
On line 53.
Oh.
Page 3 of that document.
I think
That's all
CCMSI is doing OJI claims.
All inclusive on both of them.
From a TPA, yes, from a TPA perspective, correct.
What does it cost the county now for that OJI administration?
Well, that's what the comparison is for on the colored sheet. That shows you if we did a comparison of our current claims based on line of coverage. Yes, sir.
That cost is included in both?
Yes, It shows you by, if you look, like on the first it says coverage code, APD, that's auto physical damage.
Okay, other questions and discussion?
I have another question.
I'd respond to Mr. Hester's.
Oh, Mr. Sandvig, yes?
I'm sorry. In defense of the CCMSI number, as was mentioned, we had 253 vehicle losses, and so many of those were due to hail. In a normal year, this $177,000 or $180,000 number would be lower.
That is correct. And likewise, you would have to move the number down by the difference of the Brentwood services as well, which there's only a $2,000 difference in those two numbers. So if you look at, to Mr. Sandvik's point, if you look at the other lines on there, that would give you a better understanding of what you would see in terms of a normal year.
Ms. Hickerson?
Looking at this, there's $3,500 on the J. Smith Lanier for the historical, looks like upload to a new TPA. But another big thing is, can we even grasp the concept of what the takeover cost per claims would be by switching on the second page that everybody was handed? There's a takeover claims incident. And I'm assuming what is happening on June 30th as of July 1, if that's still on the books to be handled, these folks are going to charge us this dollar amount per
run-in fee. That's correct.
So that's an additional on top of the difference, or possibly an additional on
All right,
top
but
of the
that's a
difference.
one-time expense, and that's going to happen any time that you move from one to another. The $3,500 is waived if you take option 1, which is the optional flat fee.
So you're saying $3,500 would be the most that it would be if we chose?
The $3,500 conversion one-time fee is waived if we take the optional flat fee of $110,000.
back to what Jeff Sandvig was saying, struck a chord. If we looked at the colored chart and we didn't have the experience like you were speaking of for the hail damage, and that was subtracted from both of their line numbers, as you just mentioned, that would have put us we would have paid less with CCMSI than we would have with Brentwood Services, because their flat fee is $85,000, and with CCMSI we would have only had to pay $80,000 for the same service if we subtracted out the hail damage. Are you following me? Is that what you were saying? Yeah.
So you had to look at this piece, and then you had to look at the broker side of it. You got a $60,000 fee versus a $10,000 fee. There's other cost in there as well that you had to consider. So when you look at it from a global perspective, all in, what is the best option? And you're going to find it CCMSI.
Mr. Hall.
There's one question real quick. Also the $50,000 deductible instead of the $25,000 deductible on the vehicles and stuff. I mean that in your automobiles, that's going to just the fleet of patrol cars and stuff like that. You're going to automatically just mark off cars, I guess, instead of some of them possibly having the replacement value to be able to be within the deductible range to be able to get some of them. So
yeah, I would agree with that.
So which one had the 50,000?
That would be the J. Smith Lanier.
J. Smith Lanier. And 25,000 deductible on CCMSI. Okay. Interesting discussion with a close cost projection with other differences that are back and forth. So what other discussion do you have? If you have any more, are we ready to vote?
We would need to know which option is being recommended if CCMSI is chosen.
For the motion, which option were you recommend? Option 3? And is that okay with the maker of the second? Any other discussion? Ms. Anderson, I believe this would be wise for us to call the roll.
Donna Andrews, CCMSI, or J. Lanier?
Okay, yes or no? What did she?
Oh, I'm sorry.
I didn't hear what she said.
Okay.
We have a motion to accept the proposal from CCMSI.
Okay. Donna?
Option 3. So they just need to say yes or no.
Susan Boney? Yes. Mayor Burgess?
Yes.
Elizabeth Crace? Yes. Commissioner Ely? Yes. Virgil Gammon? Yes. Greg Hall? Yes. Regina Harvey? No. Donnie Hester? Yes. Mary Hickerson? Yes. Commissioner Jordan? Yes. Commissioner McAdoo? Yes. Joe Russell? Yes. And Jeff Sandvig? No. 2 noes. 1, 2, 3, 4, 5, 6, 7.
Okay, then motion carried.
Oh, yes.
Okay, we're through item 7, and ladies and gentlemen, we've got a good bit of heavy agenda to cover. So I've had a request that we take a 5-minute break, and then we'll be ready to get going and finish this up here in the next couple of hours. Okay, ladies and gentlemen, we're back in session with the Rutherford County Benefits and Insurance Committee. We want to move along as quickly as we can, but we can't get to agenda item 11 until we cover 9 and 10. They're an integral part of that. But in any event, we've been assured that the next 3 items will go just in a matter of minutes here. Stop loss premium. Mrs. Stinson, please move us on that one.
Yes, so I'd like to ask Mr. Huffman from Cigna to approach. He'll be covering this information for us.
All right, Mr. Huffman, tell us about this and tell us what we should do, or suggest what we should do.
Okay, Ms. Stinson asked me to just walk you through the stop-loss insurance renewal. This is effective July 1st every year, and because this is an insured product that Cigna provides on an annual basis, we do provide a renewal each year that is developed about this time, or about a month ago. So this does not is not a part of the 3-year contract or the ASO fees that were already established last year. This is something that we provide each year that requires a decision by you. And if you'll look at this page, you'll see the current rate that is set today, which is $5.48 per employee per month. That gives you individual stop-loss pooling level of $750,000 per claimant. In other words, anything over that amount, Cigna is on the risk for and will reimburse the county for that amount. So maintaining that level of coverage for next year, underwriting calculated about an 8.6% rate increase need to take that rate up 47 cents to $5.95 under option 1. I believe that is the option that Ms. Stinson is recommending. Option 2 and option 3 create a higher pooling point at a lower premium, but puts more risk on the county. Typically what we see on a year-to-year basis with our clients is stop-loss leverage trend is typically about 18% per year, assuming you keep your pooling point unchanged. So at an 8.6% rate increase, also with the losses that we've had on the stop-loss premium over the last 5 years, it did seem to be a very competitive renewal to present.
Okay, so that's the report from Mr. Hopman. Now what, and Ms. Stinson, you want to add anything to that?
No, sir. I think that the recommendation to the committee is to accept the current individual pooling level of $750,000 with a composite monthly rate of $595, effective 7/1/2013.
Second, Mr. Sandvig. Any other comments or discussion or questions? The bottom line is, with our experience, we don't think we should increase that individual pooling level beyond $750,000. We need to.
Correct.
Okay. Any other discussion? If not, all of you in favor of that, please say aye. Aye. Any opposed? All right. Thank you. Now, thank you, sir. We appreciate that. Ms. Stinson, tell us about bariatric surgery benefits.
Okay. During the insurance work session, a discussion was held regarding the bariatric surgery benefits and whether or not it should remain in the policy effective 2014. I was requested to provide more information to the insurance committee regarding this, and I've provided that to you in your packet today. If you'll look at the bariatric surgery claim experience, the base period is for the period of July 2010, July 1st, 2010 through June the 30th, 2011, with the current period being July 1st, 2011 through June the 30th, 2012. During the base period, we had 7 claimants for a total paid out of $165,936. For the current period, we had 3 claimants for a total paid of $75,881. During our discussion in the work session, we were considering removing this benefit. In light of the actual claims experience information and with the other things that we were reviewing for the medical plan for 2014, it's my recommendation that we not affect this benefit until we have 1 more year of experience to see what our actual normal trend in the benefit is. Since during the base in the current period, we had nearly $100,000 shift in claims experience, I think it's premature to make that decision to remove that benefit, and we need to wait and see what an additional year reveals.
Okay, you've heard her report. Mrs. Harvey? And we continue with the bariatric surgery benefit. Do we have a second? Mr. Gammon and others, any other discussion? All of you in favor of that, please say aye. Aye. Any opposed? Thank you very much. All right, plan changes.
During the work session, we talked about ways to control the premium increase that is facing us as a county. One of the recommendations that we brought to the table was to make changes to the actual plans themselves. What we have recommended is that on the copay plan, we move the annual deduction to a 1,000 person in-network, 2,000 out-of-network person, 2,000 family in-network deductible, 4,000 on the family. For the annual out-of-pocket, the recommendation is to move it to 4,000 per individual, 8,000 family for in-network, $8,000 per individual for out-of-network, $16,000 per individual for family. And can we project this information for those who didn't bring their documents from the work session? There you go. For the ER copay, we're recommending 100% after a $300 per visit copay, both in and out of network. For an urgent care copay, we're recommending 100% after a $60 copay, and mail order 90-day retail moving to $12, $75, and $150, which is below current plan design, to encourage greater use of 90-day at retail and mail order pharmacy. For the deductible plan, we're making a recommendation that we increase the individual out-of-network deductible to $1,000, the family deductible and out-of-network to $2,000. For the annual out-of-pocket maximum, we're recommending that we move to $2,500 per individual for in-network, $5,000 per family for in-network. Out-of-network for annual out-of-pocket be moved to $5,000 per individual, $10,000 per family. For the ER copay on deductible, in-network 80% after deductible, $300 per visit copay. On the out-of-network, $60% after deductible, $300 per visit copay. And the mail order be changed to $12, 15%, 30%, no deductible, which is a decrease over current to encourage greater utilization of mail order pharmacy and 90 days at retail. For the HRA plan, we are making the recommendation that we move the annual deductible to $1,750 for an individual on the in-network benefits, $3,500 family collective. On out-of-network, we're recommending $3,000 for an individual, $6,000 for family collective, and modify the mail order pharmacy to be 25%, 35%, 45% deductible applied, which is a decrease over the current mail order pharmacy 90-day retail design. If we approve these recommended plan changes, the expected changes from the expected savings from these plan changes is estimated to be $675,700 for 2014.
Okay, she gave us a lot of information there really very quickly.
$675,700 is the total savings expected from plan changes.
Now, Ms. Stinson, you've already taken into factor this $675,000. You've assumed we're going to get that with the numbers that you've created for the discussion that's getting ready to come up. Is that correct?
Well, we have exhibits for both ways, which is why it's important that we make decisions on this prior to discussions about rates.
So you can know which exhibits to go. So if we don't do this, you'll have to add back $675,000 to the other needs? Or?
I have an exhibit already that will show that.
Okay. Ms. Harvey?
Okay, the biggest concern that I have heard from the REA members, the teachers, support staff, is the ER copay, where we go from additional $250 may apply to automatically $300 applying. Can you give us a little bit more information? I know you did some at the work session about what percentages of people we're seeing going into the ER and the cases and what that is actually costing us, because that seems like a huge dump for some people.
I can tell you the numbers I know off the top of my head, and then I can dive in deeper if you need me to. The reason that this recommendation is being made is twofold. One is we have about a 30% steerable visit to the emergency room. What that means is that people are utilizing the emergency room when a lower level of care would be available that would cost both them and the plan. Even though we say $250 may apply, I feel very confident saying that is never charged, because at what point do we determine whether or not it was viewed as a true emergency by the individual who went for the care? But what we do know is, based on the diagnosis codes passed back through the claim file, that about 30% or so of those could have received care elsewhere. So therefore, we want to drive behavior. And the way that you drive behavior typically is affecting their out-of-pocket cost. We have help to ease the burden of those after-hour, meaning after our MedPoint clinics have closed, those after-hour needs, by extending services into the retail clinics in Middle Tennessee for Walgreens Take Care. So someone that goes home after work and it's 5 o'clock and they realize that their child is ill can have those later evening appointments in a walk-in clinic situation inside a retail clinic. So the fact that we have improved on one side of the equation, we need to revisit what we're doing on the other side to have a balanced program. And that's why the recommendation is being made to actually increase the out-of-pocket cost and actually apply an out-of-pocket cost to the ER.
And with a follow-up question on that, in the past, we had a fee if you went to the ER, and if you were actually admitted to the hospital, that fee was waived. That became void, I believe. And that's not the case with this $300. If you go to the ER and you are admitted into the hospital, you would still have the $300 fee. Is that correct?
No, you would not. Once you're admitted, that fee would be waived.
Other questions? We need a motion on the floor if you so choose to make one.
Motion to approve as presented with the changes.
Second, Mr. Jordan. Other discussion or other questions? The motion is to accept these changes that you see outlined on your packet and on the screen up there. All right, if there's no other discussion, then all of you in favor of that, please say aye. Aye. Are there any opposed? Okay, thank you. So now we're ready for 2014 dental and medical premiums. And what we're going to do here, there is some fundamental discussion that is going on that... Oh, you want to do the dental first? And that's going to be an easy one too,
Yes,
right?
sir.
Okay, let's do the dental.
Okay.
No change.
Dental is it's very quick. Dental shows that it's self-sustaining. We do not need an increase for 2014. The recommendation to the committee is to hold the current 2013 rates flat for 2014.
Motion from Ms. Harvey and Mr. Sandvig and others. All right, any other discussion? All in favor of that, please say aye. Aye. Any opposed? Thank you. Okay, now we're ready to talk about medical premiums. And there's a component that's been discussed over the last few weeks regarding, in particular, our pre-65 health care retirees, you might say, and their influence on what we need to do here. So that being said, we really can't delve into the big picture until we sort of decide where we're going with that group of individuals. So what we're going to do is allow Mr. Sandvig on behalf of what the board, the school board has suggested and recommended, and then he'll have some follow-up discussion by Mr. Blair, and then we can sort of dig in quite a bit deeper on this because it is extraordinarily complex to decide what we do with this piece. We have to decide what we do with this piece before you can feed this into the complete, total, big picture. All right, so Mr. Sandvig, the floor is yours, and then you can relinquish your option in choosing to Mr. Blair.
Thank you, Mr. Mayor. The Board of Ed met Tuesday night and passed a request that the Insurance Committee and the Rutherford County Commission Budget Committee prepare a 2014 medical insurance rate proposal that will combine the pre-65 retiree group with the active employee group and set a common overall medical insurance rate for both groups, with the pre-65 retirees paying 1/2 of this overall rate. And I will turn it over to Mr. Blair.
Mr. Come up here. She says your mic is not working. That one over there. There it goes. Now it goes. Lisa got it going? All right.
Is it working?
Get right in it, though, please.
I'm sorry.
Closer.
Okay. We don't have this at the board, so this is a little different for us. Like I said, there's probably nothing that will get your attention quicker than a 50% rate increase, and that may be for all of us. So it certainly came to the attention of the board, and the board wanted to find an opportunity for relief, but we did not want to ask for relief without coming up with some sort of solution. Now, we're making a solution here, but or a proposal, if you will, but we want talked about some more. We want it back on the table. We're anxious for our pre-65 employees to not to sustain such a big hit. And when we started looking at the way our health insurance is set up, it just looked awkward to us that a group as large as we have, and I'm projecting it somewhere between 4,700 to 5,000 employees, that's a pretty good sized pot for a group plan, which basically works off the law of large numbers. And to put 165 older, of course I'm patting myself because I am older now, putting them in a group where their premium and their claims predict their rates just didn't seem to be the way it should have been set up. And we feel like possibly one of the easiest corrections would be to blend this large group back with, or blend the 165 pre-65 retirees back into the larger group so they would not experience such a hefty increase. Again, we're not trying to tell the insurance committee or the county commission what to do, but we certainly want to make a suggestion to give us a vehicle to give that group some relief. Yes, we also understand that the large group is going to take an increase also, but 165 in comparison to almost 5,000 is a pretty small addition back to the big pot. And if there's other proposals and other conversation for this group to have some relief, the board would be grateful and just appreciate the opportunity to look at this again. Thank you, Mayor.
Okay, thank you. There has been much discussion about that internally and externally, and we've looked at it in any number of ways very carefully. I was just thinking to myself, one of the fundamental rules within physics is for every action there's an equal and opposite reaction. So when you push the balloon here, it squishes out over here somewhere else. So all of that's sort of the fundamental principle in place here. So we understand that. I don't know how we sort of engage this discussion, but we are prepared to engage the discussion from a number of viewpoints, and hopefully that we can thoughtfully come to some reasonable decision here as we go forward. But we can't really move forward with the whole plan and what we're going to do with the other components until we really sort of set direction on this issue. So Ms. Stinson and Ms. Nolan can give us their input, and they've got spreadsheet after spreadsheet, I think, here. So
I'm asking Ms. Perrin to come forward and distribute these forms. I've spoken with Mr. Blair on a couple of occasions, and I've watched the Board of Education meetings, and I do understand the issue at hand. And I don't disagree that in terms of the cost, we can expect to see the costs continue to grow substantially while they are carved out. So the committee today basically has one of three decisions to make. One, to decide to leave it as is. Two, to decide one of the recommendations you will see that doesn't blend the rates, and another to decide to blend the rates what occurs when you do that. I would like to say that 50% is a substantial number. That's undeniable. 50%, however, represents 35.25% of the actual needed increase. They need 160%. We have recommended a 50%. That is a 35% increase of the needed rate. When you look at the claim dollars, and Ms. Nolan spoke about this briefly the other day to the Board of Ed, to the board members, when you look at the claim dollars for 2012 fiscal year, our per employee per year cost, when you combine medical and prescriptions, and this does not include the MedPoint clinics, which both actives and retirees have access to, that cost is $9,796 per employee per year. For a pre-65 retiree, that cost is $14,945. So there is a substantial difference. There's a $5,000 difference between an active employee and a pre-65 employee. I say that because Ms. Nolan talked about our OPEB liability and what we have to book. If you look at the bottom of your financial report, our current OPEB liability is at $60,783,000, and I believe our ARC, which is what we are to reserve monthly, is around $12 million. Is that correct, Ms. Nolan? We aren't contributing anything to that currently. It's already been brought to us from the audit perspective of what are you going to do to address this? One of the concerns from the finance office is what is the possible impact to our rating, such as Standard & Poor's? Well, if they impact our rating when we need to borrow money for a school, we're going to pay a higher percent of interest. So there is a snowball effect. It is not as simple as whether we blend or not blend. But I do hear the school board, and I understand that the recommendation is to offer relief. If it is the desire of the committee to bring about a rate increase similar to what an active employee would experience, then I'll refer you to the overhead. And you actually have before you 4 sheets of paper, of the colored sheets, the big sheets. And I'm going to refer to you, some of you all have taken the explanation I sent, kind of marked them. If you will look at the one that says at the top, which would be your number 1 if you did what I just described, employee contribution adjusted, 90%, 87%, and HRA, 100%, 100%. Okay? What that sheet will tell you, look in the orange column all the way to your left. So if this is your sheet, I want you to focus here, right? If we were to take the necessary increase for the active population, which equates to 24.6%, a county general employee who is enrolled in the copay plan for individual coverage will have a monthly rate increase of $8.82. Someone in Employee Plus Family would have a rate increase of $49.72. On the deductible plan, the individual
What's that?
They're still looking for the pay. Are you ready? The individual would pay $10.07 more per month, and then the family under deductible would pay $56.82. So if that's our intention, and that's what we want to get to, is what is a similar increase? Now, recognizing that this represents an 87% contribution by the county, which that will be up for discussion. We already know we have to go to 87. We voted on that last year. We may modify that as well. But if we want to look at balancing the equation, then the recommendation would be, because of all these other things I just described, the OPEB liability, these other factors, to do a 1-year adjustment for the pre-65s, 1 year, 2014, and adjust the county contribution on the single rate to 65.5. So 65.5. On the family rate, adjust it to 63.5, and do the same thing on the deductible plan. And what you see happen is that pre-65 retiree now pays $9.90 more per month in 2014. The family plan participant pays $48.14 more per month. On the deductible, it's $11.31, and on the family, it's $55.01. So if the intention is to make them equal to the actives, that has basically done that. Someone who's an active employee enrolled in the copay single plan would pay $8.82 more next year. A pre-65 retiree enrolled in the single copay plan would pay $9.90. So that's one way to equalize this for a one-year period to allow us to explore other options for the pre-65. Now, the sheet that was handed out in front of you shows what would occur if we blended the rates. And all the numbers that I'm giving you today include plan change information. So you need to go to the blended with plan changes. You got it there? Okay. So in this scenario, if we blend the rates, this is what would happen. A pre-65 enrolled in the single copay plan would actually pay less than they pay today, to the sum of $26.78 a month. We would have to go to 4 tiers at that point because you want to match premiums, right? So now you have to do a cross-examination. Under the model that we looked at first, an employee enrolled in the copay family with a 50% rate increase applied. Now, mind you, at 50%, we're booking over $1 million up to the active rates on that first sheet that you saw. But with the 50% increase, paying 50%, their premium would go to $256, would go up $256.36 for a total premium of $760.07. Okay, so that's the number that we need to look at. That's $760.07. When we go to a 4-tier, we also looked at the enrollment inside of the pre-65s. Currently today, because we only have 2 tiers for pre-65, you're either single or you're in the family. When you break it down to a 4-tier, we see of the 18 individuals enrolled in family copay today, that 12 of them would move to an employee plus spouse rate. They would then pay $537.63 a month on a blended rate. If we don't blend and we do 50% increase at 50% contribution, they would pay $760.07. Under a blended rate, an employee plus spouse would pay $537.63. For employee plus child, they would pay $473.63 versus $760.07. For employee plus family, they would pay $742.44 versus $760.07. For the deductible, you look at the single rate would drop below current rate by $28.92. For employee plus child or employee plus spouse, they would move from a family premium of $868.65 to $617.97. Employee plus child would move from a rate of $868.65 to $544.38. The family coverage would move from $868.65 to $853.39. I don't believe it was ever the intent of the board members to make a recommendation that actually reduces premiums for any population of the pre-65s. And if you look at the single rate, the enrollment on the singles is around 117 people, 118 it appears. So the biggest population of that 165 pre-65 retirees, if we blend the rate, will actually pay less next year than they pay today. In talking with other counties, what other counties, some do, not all, but some actually do a contribution based on years of service. And maybe the right decision is to blend the rates. A lot of people do. But if we blend the rates, does the county still want to pay at 50%? Our youngest pre-65 retiree is 50 years old. We have children as young as 3 participating in the pre-65 model. There are a lot of decisions to be made about blending the rates. It is to the advantage of the pre-65, that is undeniable. But it's not to the advantage of the others who contribute to the overall pool, because when you do this, you're basically adding 3 points of increase to the active pool premium. So an active employee today will pay 3% more so that the pre-65 retirees can have a blended rate. I'm not recommending whether or not that's the right thing to do. What I'm saying is I think it still needs a lot more investigation and study. And if the intent is to just offer relief and to get the pre-65s in a rate increase similar to what an active will experience this year, then the first recommendation may be the right recommendation. Let's do a 1-year subsidy.
Ms. Nolan.
To follow up, on the accounting side, whether you blend the rate or you do a different percentage, it's accounting-wise, you're doing the same thing.
That's correct, because you are still booking that $15,000 per employee per year towards our OPEB.
Right, so if a decision is to blend, in the calculation, there will be a calculation of this is how much the entire retiree population cost, and this is how much the retirees paid in. Meaning, then the rest is what was paid by somebody else. So whether it's blended or, as you suggested in the first part, a different percentage, that calculation will net out and be the same thing.
And have you asked the actuaries if we do that, what we could expect?
Well, I can just tell you what the phone message was, that I got, because usually when we would send things to them, it was not a quick turnaround. It has to go through their number crunching. But going from what I was proposing to them, a 70-30% split, she said definitely, my message was definitely it would have an effect on our ARC, meaning that when they look at it, they'll say in all the future years, this is what will happen. It will be, they would look at the people here retiring in the future, and that split would be 70-30. But I did not talk to her to propose, what if we just said we were doing it 1 year and that's it, and it would revert back to 50, I didn't have that conversation. So ultimately, no.
Okay.
I don't have an answer. But other than it would have a significant impact.
Okay, well, let's stop right here. Does anyone have questions? Because, this is pretty complex. In either event, whatever we do, however we do it, what Ms. Nolan is telling you, it has consequences. We will have to pay these projected liabilities. They are real. So we've had this discussion over the past few years, but at some point, even if this first initial proposal where we needed 160% increase, we were just proposing to get 50% increase, which is still kicking the can down the road. So it's still at some point we have to address how we're going to actually accomplish getting these premiums that we're going to be receiving for these experiences that we're having in healthcare to actually cover them at least.
And if I could I want to make sure that everyone understands what we mean when we say blend the rates. It's basically when we take the experience of the pre-65s and we roll it into the actives and we come up with one total rate. That total rate equivalent for a single on the copay is $512.03 as an example. For the family, it's $1,484.89. when you look at some of these other proposals, the conversation that I want to be careful and guarded against today is saying, let's leave them separate, but let's just not give them a 50% rate increase. Because we've already rolled $1.4 million to the actives. We're already subsidizing. And we have to have our budget. We know what happens when we don't fully fund the budget. We end up with a shortage. We had over a $2 million shortage last year. We certainly wouldn't short our payroll and hope that people quit and we don't have to replace them very soon. But what we're doing when we short our budget for our employee benefits is say, hey, we hope our people aren't as sick as what we really know they already are and project them to continue to be. An employee wants to be paid and people want their claims paid. We certainly don't want to be a company that floats money and funds our claims late, because then the doctor's office starts calling employees. If we pass an increase below 50%, whatever that amount is goes to the actives. We simply can't say we only want to take a 24.6% increase to the actives and we just want to give the pre-65 retirees a 20%, and we'll roll the dice on that 30%, because it's exactly what you're saying. That 30% has to come from somewhere. So I'd like to hear from the committee so we'll know how to proceed. Which of the three options seem to be most attractive? To accept what we originally proposed, to do the modified version with the one-year stipend, realizing that when we do that, it is, scary is not the right word, but as I come up on the end of a 2-year employment with the county, I can't tell you how many times I've heard that's the way we always do it. So it seems like once you start something, it's really hard to slow the train. But we would have to have a strong commitment that it's a 1 year and that we're going to come up with a solution that's the right solution for everybody, the taxpayer, the employee, and the pre-65 retiree. And then the other option is to blend. Is that what we want to do this year? So I'd like to hear some feedback from that.
Okay, Mr. Sandvig.
Ms. Stinson, what are some of the possibilities if we were to go with the 63 point whatever for a year? What things are you thinking of that could then be introduced?
Sure. I think that one is the way it is. We would blend the rates, see what the increase would have to be next year. I think that the thing that's so glaring about blending the rates and leaving it as is that reduction in premium. Is that the right thing to do? You know, fair was used a lot by the school board, and I'm not trying to point anybody out, but the reason this is brought to the table is because it wasn't seen as fair. Was it fair to give a reduction in premium and charge a population that really benefits not at all more money? So I'm not sure that's the best solution. There are other options, such as Extend Health, which is a company that I started talking to January, February, I don't know, and said, you're going to have to wait, I've got to get through other things first, that has some products that may be a better solution for us. We need to look at our contribution rates. Is it that we really intended to give someone with 15 years of service the same county contribution level as somebody with 30 years of service or 40 years? I can tell you that in watching the school board meetings, I continually heard 30 and 40 years being referenced. I never heard 15 years, but the reality is we have people in that category who worked for Rutherford County for 15 years. So I think that there is opportunity to look at a couple of different perspectives such as that, but that takes time, and we don't have the time, quite frankly. We're coming up on the end of the fiscal year, and budget has to be set. But if it is the desire to do the relief and bring them in line with the actives, the first proposal is the way to do it. Makes it for a very short discussion, and it meets the needs of the pre-65. Because really, whether you blend it or you don't blend it, because the county contributes so much, the taxpayer is really the one picking up that piece. The employee themselves, when you blend it, is picking up a small piece, because that 3% I referenced is to the total rate. Our employees either don't pay anything or they pay some percentage thereof, depending on what plan they're in.
Ms. Hickerson?
All right. instead of saying I told you so like I always do with it on the rate increases, I'm willing to compromise because what is in black and white is 50%. And we've done that because we've gotten ourselves in a hole over the last several years. So the compromise would be to go to the 65 and the 63% with the additional decimals there, because if you blend it, you've got a person now with less than 6 months or less than 7 years of service that don't even have the pre-65 plan option for them when they retire now, and you're asking them to pay 3% more. And yes, there are some people on it that just had 15 years of service. You can have as little as 10, because I had a couple of guys that had as little as 10 years of service based on their age when they come and went, that they could and existed in my pre-65 group. So the blended and deciding that right now is not a good option, and doing it today is not a good option. To satisfy the break and wanting some relief, and I understand it, and I get that. I think we really should just go with for this 1 year only. And I even say that we look at the existing numbers of 165 people, give or take, that are on the pre-65. That should be the only ones that get this 65.5 and 63.5 percentage break, because everybody was made aware when we drawed the line in the sand on December 31st, 2010, how you would be affected by the insurance. We keep this up, in 2 or 3 more years, we won't have it. In an article you sent us, it went from 60% of retired folks had this option in the 80s. 25% of them offer it now, and the majority of the corporate world don't even exist. So we need to make it where we can at least offer the coverage for the folks we got working. And if we keep making this impossible, the folks working can't afford it.
That's just a comment. You didn't make a motion, did you?
Well, I'll make that motion.
I want to clarify one thing. I just want to make sure I understand. Is that okay? I want to ask one question of what she proposed, make sure I understand.
Okay. She wants to ask you one question before you make the motion, maybe.
So are you saying that basically we would have a grandfathered and a non-grandfathered pre-65 group for 2014? The grandfathered would receive the subsidy for 1 year of the 60+%. Anyone that retires effective January 1st, 2014 or after would have to pay 50% of the total rate. So just like it originally presented. So we would apply the 50% increase, and anyone who retires after January 1st would pay 50% of the true rate. But if you're already in there, we're going to go ahead and apply that 50% increase, but we're going to pay more by the county, and therefore they will have an advantage for 1 year.
1 year. Mr. Jordan?
Well, does that mean that 506 would go to 742, or would it go to like the 1200 number we heard? Because that's actually was a compromise number going up to 50%.
The 506, where are you looking at? Can you give me like a column number?
365 family, it's 50671 2013. Next year's projected at the first option was 742. Is that the number Mary just alluded to? Because that's a kicking the can down the road number, actually, you know. And we said we actually needed, that was only 35% of the adequate raise. So you're talking about that number being a 742 or being a, I heard a number
about being 554.
Huh?
We're talking about it being 554. So rather than paying 760.07, someone currently enrolled in 2013 for 2014 would pay
I understand the ones that had to, I'm talking about the ones that aren't grandfathered, the ones that are going to retire next
Right,
week.
they would pay $760.07.
So it'd be the number that's reported up there.
The number that's reported on
Option 1.
Number 1.
Number 1.
Yes.
And that would be the grass holding our heart and OPEB, but putting the number of only 165 people
For that 1 year, yeah.
for 1 year.
All right, Ms. Hickerson, do you want to see if you can excuse me?
I'll second her motion, but I want to, but her motion also included doing this 63.5.5 and 63.5 for the 1 year, because I think we've definitely got to come up with some options. We've got to adjust something, because if we took option 1, we're going to beat these employees or retirees over the head, and next year we're going to do it all over again, because we're only taking a third of what we need. So that's just kicking the can, and a 500 and something to a 700 and something is terrible, and next year it's going to go up again. So, and I'm awful scared of blending that rate, because once you blend that rate, you never get it separated back out again. And we could, and I've only heard about this discussed the last 4 days and stuff. So I think it'd be a little quick to blend that rate for eternity, because once it's blended, it's never separated back out. So I think we should go with the temporary thing this year, and we may even decide we need to blend the rate next year. But with these percentages like they are, it's a very minor increase. It's across the board, everybody, employees and non-employees. I've had people calling me, think their insurance is fixing to go from $500 to $1,200. That's not going to happen. It'd still be something everybody could live with. So I think this is we're putting it off. We've got to do a lot of work. Or Ms. Stinson, Ms. Anderson, and your staff have got to do a lot of work in the next year and bring us back a lot of good news.
Okay, so we do have a motion. Now, Ms. Anderson, do we need to read that back, or do you have that written down so carefully that we understand it?
No, sir, I don't have that written down so carefully.
All right. Let's see if we can see what Ms. Hickerson, would you like to repeat that, or do you want me to see if I can?
It doesn't matter.
Okay, you try that.
I'll try. All right, we'll go with the motion of make sure my numbers are right, 65.5% on single rate and 63.5% on the single rate, family rate, I'm sorry, on pre-65s.
With a 50% rate increase attached.
With anybody after retiring after?
Now, you're going to originate with the 50% rate increase to the total rate. And then we're going to increase the county contribution for 1 year.
Correct.
For those currently enrolled in the pre-65
prior to what
prior
date?
to 12/31/2013.
Correct.
Anyone who enrolls in the pre-65 retiree plan between January 1, 2014 through 12/31/2014 will pay 50% of the total premium rate.
Yes. My only question is, do we need to move the date to the budget year works off the fiscal year of 7/1 to 6/30?
You can't change the rate right now. You'd have to have a full open enrollment. They're not going to have another plan election between now and the end of the year.
Right, but you can draw the line on when they retire, on the retirement date. We're letting anybody that retires from today till December to get on board.
Okay.
I'm asking.
That would be better for the employee.
Yeah.
Yes, to allow them.
Hours between now and December the 31st would.
So either currently participating, currently enrolled, or who retires and enrolls between now, who retires and enrolls in 2013 is basically what you're saying.
For accounting purposes, would it be actually better if we move the dates up to July 1st than account on our fiscal year?
I think I don't know that that's best for the prospective retiree, because you have county general people who aren't on this school cycle. I mean, the school pretty much, they retire at the end of the school year. not always, but majority. Whereas a county general person may retire in November. So if you move the date up to July 1, and you say if after July 1 then you get the non-grandfathered rate, then you're going to affect county general employees doing that. You're setting up unfair circumstances.
Okay, so your motion didn't include this last discussion. All right, correct? All right. Do the members of the insurance committee want us to read this back to you, Ms. Harvey?
I just have a question for clarification. We are looking at, to get the numbers, because I really can't see on the screen there, we're looking at the white sheet that says 2014 premium proposal, plan changes, and employee contribution, 90, 80%, HRA 100%. That's the form we're looking at. And those are the numbers that we're getting. Is that correct?
Are you looking at this sheet?
No.
Looking at the
We're not
colors.
looking at the blended sheet.
All right.
She's looking at
said
number.
no to blended.
Yeah, she's
Her
looking at number
proposal
2
does.
in your packet with.
Oh, she's
plan
looking at number
changes.
2.
Well, I just listed it as number 2 because that was
Yeah,
the
that's
second
right.
one on the list.
You're right. Because you're doing with the plan changes there.
So those are the numbers we're looking at. And that's what we're voting on, that if you're participating right now, it's going to be a cheaper rate, but after January of 2014, it's going to be the rate that's on the printout.
Wait just a minute here. Let's let Ms.
And we're trying to get that spreadsheet
Find it.
updated.
Let's stay on point because we got to answer her question first.
Since she's working off of the one with the plan changes added in, we're switching over to the plan changes sheet. Take them to this.
Now, sheet 2 has the plan changes in it, and sheet 1 did not.
Right. I just want to make sure I'm looking at the right numbers.
Right.
Wait.
No, she's talking about the pre. You're talking about pre-65.
Pre-65, yes.
So when you include the plan changes, I'll just read the numbers because this is moving so slowly. In a copay plan, single coverage, employee, and these are county general, of course we do the 10 months rate on the Board of Ed, $850. For the family copay, $48.53. For the single deductible, $990. For the family deductible, $56.16. When you modify the rate that the county will pay on the pre-65, the pre-65 pays $990, whereas an active employee would pay $850. They would pay, it would be how much more they pay a month. Right, how much more would they pay a month? They would pay $990 a month. They would pay $48.14 more a month, whereas an active employee on the family plan copay would pay $48.53 a month. And on the deductible plan, is that the one we just went through? They would pay $11.31 more a month, whereas an active employee would pay $9.90. On the family plan, they would pay, what's that number? $55.01 more a month, whereas an active employee would pay $56.16. So the numbers are still close.
But what her motion is just covering is the pre-65 group and not the active group.
That is correct. That is correct. So what will happen is we will still apply that 50% rate increase. We will modify the county contribution to the 65.5, 63.5 for 1 year. The only group who has the advantage to that subsidy for 1 year are those who are retired as of 12/31/2013. Anyone who retires January 1st, 2014 or after will pay the 50% of the total rate. So if you retire on January the 2nd, 2014, your premium for single copay will be $424.19. For family, it will be $760.07. For deductible single, it will be $484.79. For family, it'll be $868.65.
Okay, has that answered your questions, Ms. Harvey? Are there any other questions now? Mr. Hester.
Melissa, when you compare this option and the total cost to the county for 2014 and compare that to what we spent for 2013, what's the increase amount?
Well, we're not through 2013 yet.
Well, I'm talking about just the premium portion.
So what the budget difference is what you're asking. Can you figure that quickly?
Care for, the difference, the overall difference. This is assuming the actives and the retirees, which next conversation will be the actives after we get the retirees, but at this point it's a 24.1% overall increase with the employee and the county.
He's asking how many more millions. Can we do that quickly?
What's the question? In millions?
He really wants to know that if before this the budget is 58 million actives, 4 million retirees, how does it adjust to the county? Because since the county's subsidizing. So really you would have to look at it's 50%, what is it, and what is it when we move it to 63? 65, 63.
$6.2 million, we're coming up to 4.7.
So you assume the delta is being passed.
Right.
Raise the contribution level when you raise the contribution level. Yeah, that's what I'm saying. Basically, what you'd have to do is you're going to
compare this number here to this new number
right
over here.
and see what the difference is. What your resulting premium is under this versus what
to the county.
Mm-hmm.
If I'm looking at this right, for last year, the cost was $44,632,000.
Looks like it's gonna. Is this the total number, Jay?
That's the total at the 50%.
Okay. So we'll have that number in just 2 seconds. If you can just let us. We'll have the number in just a second.
It's 707,147 for a difference of.
I understand your question. It is, what are we putting back on the county whenever we increase for this subsidy? Is that correct? So it's a difference of $331,082.
Retirees?
Yes, just for the retirees, for the pre-65 retirees.
Okay, so the answer to his question in a simplistic way is by making these changes to the 65.5 and the 63.5, the county is going to have to accept $335,000 more as its contribution.
And 31 based on current enrollment, yes. 331,000 based on current enrollment.
So, okay, other questions? Mr. Sandvig.
I am concerned about the one-year nature of this fix. It's not going to be any easier to fix next year. And I don't know if this is appropriate, but I would like to suggest an amendment with the blended plan whereby for the single we do not drop the 2013 rate.
You're asking for a rate pass?
Well, no, on a blended, where we blend both groups, since the single group would have seen a drop, that we not drop that groups.
So, right, which would be a rate pass for 2014.
Well, rather than a drop, yes.
Right, rather than drop. So in a group that needs a 160% increase, what we're proposing is to not reduce their premium, but to charge them the same as they currently pay in 2014. Is that right? So today they pay $282.79.
Right.
And you're saying in 2014 have them pay $282.79.
Right. And kind of and then as increases go through, until there is an increase that takes that 256.01 up, base number up.
Right. I can't speak for the committee, but I want to make sure the committee understands that recommendation. Basically, what that means is we're not going to give them a rate increase at all. We're going to charge them the exact same thing in 2014 that we're charging in 2013, but we're going to give rate increases on their behalf to every other entity on the plan.
And then I would go with the plus spouse as presented. On the plus child, I can understand that concern of not lowering that rate. But I feel that I must make this amendment in light with the vote of the school board.
That's your motion on an amendment to the original motion. Do we have a second? Ms. Harvey, discussion on that? Mr. Hall?
If we were to do that, I mean, that's just or it solves maybe a little bit of what your goal is, I guess. But as far as the overall coming up for the county, for the entire plan, for all the employees and taxpayers, it doesn't really do anything for solving the problem, the bigger problem of what we need to do. And I don't know that that using this year wisely, the work groups that y'all have put together and worked together and things that we've done for GASB and for other things have really helped the county and done a good job. And I think that year that we're talking about here that Mary is putting together on a motion would probably, better benefit all the employees. I was thinking about an employee who's got 13 years in or 17 years in and stuff like that. It affects them too. And so the year that you've got to do that, and I understand they're still working, so they've got an ability, but of course someone who's 50 years old, he's probably still working too and retired too. So I don't think anybody can actually just quit, and stop doing anything. But if we do that, we're not really solving the whole problem.
Well, not only it solves the problem. The problem is the pre-65 premium. So that would solve the problem because, in essence, what that would do is provide a rate pass, no increase, for the single pre-65 person. For majority of the rest, or actually all of the others, it gives them a rate reduction over what would happen if we applied a 50% increase at a 50% contribution. You have to keep in mind that with the 50% increase, 50% contribution, the single rate should be $424.19. The family rate, and I'm only talking copay, should be $760.07. So what Mr. Sandvig has proposed is that we would make the single rate under a blended be $282.79, which is the same they pay today. The pre-65s will have an advantage because we're going from 2-tier to 4-tier. So 12 of those retirees would benefit from having an employee plus spouse tier, and their premium would go from, basically, if you look at 2013, it would go from the family rate of $760, but if you look at what they're paying today, they would go from $506.71 to $537.63. Or if they have a child, they would go from $506.71 to $473.63. So that group would actually pay less, and that's 4 people, because right now they're under a family rate and they would benefit from being employee plus child. And then the family would go from $506.71 to $742.44. And that's really, and it would be $760.07 if it was only still a two-tier, and that's two retirees.
Okay, we have a motion, and we do have a second. Other discussion? I mean, you've heard Mr. Sandvik's description of what it would do. Now, Ms. Nolan?
I guess I'm not a voting member, but I wanted a clarification. Is your motion to go to the four-tiered?
And the blended.
Go to a four-tier for the retirees and to blend the rate?
Right, but to not decrease anyone's rate that would have decreased.
So
But
we are still booking, I just want to remind the committee as you make your decision, 117 out of, if my math is right, 84 and 34, whatever that is. I'm tired and I can't think that straight. 118 folks would have a rate pass. They wouldn't pay anything more for their pre-65. And we're putting 3% increase on the actives so they can have that rate pass. We're putting 10% on the post-65s so they can have that rate pass.
We've already put 20% plus on the actives to cover their actual real cost. And we're not going to put any increase in cost on the pre-65s. None. Okay. Are you ready to vote, Mr. Jordan?
I hate to disagree with Mr. Sandvik, but I'd urge everybody to vote no on this amendment because we've gone from actually beating the retirees pre-65 over the head all the way down to just Christmas, and I think we ought to spread this out evenly. We're going to have to do a lot of work within the next year. Once we, like I said before, once we blend this rate, it's blended forever. You're not going to be able to come back and segregate the ones back out. This benefit didn't even exist before 1999. The pre-65 retirees before 1999 didn't have any insurance in the county. They had to go pick it up out in the free market. That's why they're segregated, because that came in just in the last 13, 14 years. So I would just urge you to vote no on the amendment and move forward with the motion we've got. I think it's equal to everybody. It's a minor increase to everybody, and it'll put us in a better position, to make some changes next year.
Okay, Ms. Grace.
I just wanted to say that this is going to be a big changing year in insurance. A lot of changes are going to start the first of 2014, and nobody's really sure what the market's going to do. So I hate to do something right now that would last forever when we are going to see some big changes in the insurance market in the next year. So I think a fix for a year, and then go back and look and see, how much did the rates change out in the market, because they can't exclude people for pre-existing conditions, charge them more for those kinds of things. So I don't think it's a good year to just blend forever. I think it'd be a good year to help them for a year and then go back and look at the big picture in a year.
Any other discussion, or are you ready to vote?
I want to be clear about the adjustments that if we go with Mary's proposal, where's the extra money going to come from? If we take it from 50 to 65.5 and from 50 to 63.5, the money that was needed, is that going to the counties?
Yeah, the taxpayers, the county will.
Taxpayers are going to have it.
Okay,
Okay, are you ready to vote? Ms. Anderson? We're voting on the amendment. The amendment is what we're voting on. And the amendment basically said that the single under the copay, for example, would pay the same, no change. And I don't know. And on the deductible.
And that we would go to a four-tier model to benefit the other groups.
And this would include the blended rate.
The blended rate, correct.
Okay.
Blended rate. No, the original motion has nothing to do with blending. It's a one-year proposal, but this amendment is for a blended rate going forward on the four-tier. So Ms. Anderson, call the roll.
Donna Andrews.
Voting on the amendment.
Susan Boney, Mayor Burgess,
No.
Elizabeth Crace, Commissioner Ely, Virgil Gammon, Greg Hall, Regina Harvey, Donnie Hester, Mary Hickerson, Commissioner Jordan, Commissioner McAdoo, Joe Russell, Jeff Sandvig. 2 yes, 12 no.
Okay, the amendment failed. Now we're ready to vote on the motion itself. Is there any other questions on that? Are we ready to vote? All right. Okay.
Let me see if I've got this.
See if she's got it written down right, so the minutes will be right. Ms. Anderson, read the motion.
The motion was made to allow grandfathered under 65 retirees, those currently retired and those who retired before 12/31/13 will receive subsidy from the county, where the county pays 65.5% of the single rate, 63.5% of the family rate for 1 year. Those that retire after January 1st, 2014 will pay 50% of the total premium rate. Is that correct?
Yeah, the only thing you haven't included is that we are capturing 50% of the rate increase before we apply these percentages.
Okay. Are we ready to vote?
Mr. Russell? All right, we're ready to vote. I'll call the roll, please.
Donna Andrews, Susan Boney, Mayor Burgess,
Yes.
Elizabeth Crace, Commissioner Ely, Virgil Gammon, Greg Hall, Regina Harvey, Donnie Hester, Mary Hickerson, Commissioner Jordan, Commissioner McAdoo, Joe Russell, Jeff Sandvig. 13 yes, 1 no.
Okay, that motion passed. Okay, so we now know how we're going to handle these pre-65s. And Ms. Stinson, do you need time to fold this into these other scenarios so we can look at the whole picture now? Or
Yes. So the next section that we need to move on to is the post-65 retirees. The post-65 retirees are being recommended for a 10% rate increase. We will say, which we failed to say earlier, that we've added additional experience in. Before, our experience was through the end of January. We've added February and March to the numbers, so that has changed our total overall budget. Our total overall budget at this point, which is needed for 2014, give it in millions, though. They want the total.
New total, it was, new number is 63,069,805, so the number right there.
Okay. So for the retirees, we need $4,775,397. We've captured part of that. We're booking $1.4 million of that to the actives to help subsidize. Taxpayers are going to subsidize an additional $331,000 on the pre-65. The recommendation to bring the total needed premium for the retiree portion is a 10% increase to the post-65 retirees for 2014. Mr. Sandvig has a question.
Motion to approve. Do we have a second? Ms. Hickerson? Okay, questions? So is that only on the screen that we can see this? We don't have it on any of these handouts, is that correct?
It's on all of them. It's on, you can look at number 2, which is what we were working from.
Number 2.
Which is the plan changes and employee contribution adjusted.
All right, so the post-65s is a proposal for increasing their premiums by 10%. And we have a motion, and we do have a second. Any other discussion? All right, if you're don't have any questions, all of you in favor of that, seems like we don't need a roll call on this. Ms. Ely.
Mr. Chairman, I need to read my conflict of interest statement into the record, please. Because I'm a retired employee of the Rutherford County Department of Education, I have a conflict of interest in the proposal about to be voted. However, I declare that my argument and my vote answer only to my conscience and to my obligation to my constituents and the citizens this body represents.
Thank you, Ms. Eating. Okay. All right. All of you in favor of this, please say aye. Aye. Any opposed? Mr. McAdoo? No. Let the record reflect. We still haven't got down to 80% yet, have we, Mr. McAdoo? Okay. Now continue on, Ms. Stinson.
Okay, so now we're at the actives.
Now we're ready for the active.
All right, so if you will look at the same page, page 2, to the right-hand side, it shows you that they need an increase of 24.6. If you look at, if you go to the yellow box, there you go. Sorry, we're on the wrong page. It shows that they need, go up to the 24%, Jay, and show them where that is.
This one right here?
Yeah. They need an overall increase of 24% in order to meet the premium needs for actives for 2014, which equate to $58,013,415. So the first vote that we need to take is to accept the 24-point increase to the actives total premium needs for 2014. And then we will get into the discussion of who pays what. We need to set the budget first. And to set the budget first, that means we have to vote on the percentage of increase to the total premium rate. The percentage of increase needed to the total premium rate is 24% on actives for 2014.
All right, second, Ms. Crace. Discussion? Okay, this is going a little faster. All right, all in favor of that, please say aye. Aye. Any opposed? Let the record reflect. Mr. McAdoo voted no. Thank you. Now, continue forward.
Okay, now the other part. Who pays what? I sent out to you as a result of the work session 4 exhibits. At this point, the only exhibits that apply, because we passed the plan changes, are exhibits 2, 3, and 4. Exhibit 2 demonstrates current contribution levels being dropped by 1%, which was previously passed by the insurance committee as well as full commission. And we are required through that resolution to reduce the county contribution to 87% on all tiers with the exception of the individual for 2014. So if you look at page 2, or exhibit 2, it's the one at the top which says plan changes and employee contribution adjusted 90%, 87%, and HRA 100%, 100%. It's right below the top, Joe, you see it? Okay. So that's what page 2 shows you. Page 3 is another exhibit I was requested to prepare, which reads 2014 premium proposal at the top. Plan changes and employee contribution adjusted 80% all tiers. So we would move from our current model of 90-87 for 2014 to 80% across the board. The next exhibit is plan changes and employee contribution adjusted, 90% and variable by plan and tier. So I'll walk you through these exhibits somewhat, and then we can have discussion if that's agreeable. The first one that we discussed has the 90% employee, the 87%, which is what we have to do. We have to drop from 90-88 to 90-87, leaving the HRA plan at 100% fully funded by the county. This is the sheet that was used to determine the percentages for the pre-65s to equalize the premium increase on a monthly basis as much as possible. The next is the 80% projection. What I would like to point out is that on this, basically this situation described at 80% tells the same story that we just talked through on the pre-65s. If you move to an 80% contribution, you're in essence doubling the premium on the copay and deductible plan. If you will look at the employee portion all the way to the left in orange. Today, an employee on the copay plan, single coverage, pays $42.10. With an 80% county contribution, they would pay $101.20. A family coverage today is $142.24 per month. With an 80% county contribution, they would pay $293.49. An employee who has zero premium today in the HRA would pay $73.35 for single coverage, $154 for employee plus spouse, $135.70 for employee plus child, and $212.72 for employee plus family. That represents when you lower it to 80%, that represents a 163% increase to the active employee's premium, what they pay in. It's the same discussion we just had on the pre-65s. When you go to the last exhibit, this is the exhibit. If we're looking at sustainability, driving behaviors, long-term viability, this is the exhibit that addresses where are our highest claims costs inside of which plan design. Is it the copay? Is it deductible? Is it HRA? It moves more to the employee based on which plan you're enrolled in and which of those plans is the richest. On this proposal, employees remain at their current funding level for single coverage. So an employee will either have a 90% contribution or 100%, just like they do today. For the copay plan, the employee would move on employee plus spouse. We know we have to be at 87%, so they would move an additional point to 86% because we've had conversations about how the employee plus spouse costs are higher than other tiers. Our spouses cost as much as our employees on our active insurance plan. The employee plus child would have an 87 contribution. Our children cost a third of what our employees and spouses cost on the plan, which is why they have a higher contribution. And then employee plus family would represent 85%. Our richest plan, which means in terms of claim dollars, what do we pay the most out on a per employee basis, that is on the deductible plan. So you will see that we are recommending a lower county contribution on that plan because it's the richest plan. It provides the biggest benefit from a claim payment perspective to employees. 84% is being recommended for employee plus spouse, 85% employee plus child, 83% employee plus family. You can see in the orange column what effect that has to the individuals enrolled in that plan. For the HRA, we talked during the work session about the adverse selection against that. We have people jumping on the plan just because it's free. Sometimes they don't really intend for it to be their primary, and they don't realize it's going to be their spouse's primary who has insurance through their employer until time of claim, or that it's going to be their secondary. They think it's going to be their primary, but it's not. We need to encourage proper insurance selection behavior, and the way to do that is through premiums. So we're recommending that the premiums drop to 98% on employee plus spouse. Our copay plan is our next to least cost plan. You have the HRA, the copay plan, and then the highest is the deductible. So the logic used was that we're moving 2 points from current contribution on employee plus spouse, so therefore we're going to move 2 points on county contribution on employee plus spouse on HRA. On the copay plan, we are moving 1 point down from current contribution on employee plus child, so we'll move 1 point down on the employee plus child for the HRA. For the family, we're moving 3 points, so we'll move 3 points on the HRA, and you can see those premiums in the orange column. So these are the exhibits I was asked to prepare. I don't know if anyone has any questions about them, Mayor, or how you want to proceed at this point.
Okay. Exhibit number 2 is our basic one that we're working from.
Yes, sir.
With the 1 point reduction from 88 to 87. And
plan changes.
And it includes the plan changes. Let's talk about Exhibit 3. Exhibit 3 is the one that just takes a straight 80% requirement to every component of all 3 of our plans.
Right, and it results in a 163% increase in employee contributions to the plan.
So these
Basically
are
doubles their premium.
roughly doubles their premiums, and it puts substantial premiums requirement on the HRA plan, which now has none. Okay, I don't know how we do this. What's your thought about the? Okay, we could do that.
Dwindling down. Start dwindling down.
Exhibit 3 or go to the 80%, because if we're not going to get the 365, we're not going to get the actives. So my motion is to take the 80% contribution rate off the table.
Second, Mr. Sandvig on that now, and others. All right, discussion on that. Mr. Hester.
I have the same question on this. If I look at, we're looking at Exhibit 3 or Sheet 3. If I'm looking at this correctly, we're going from a county contribution of $42,384,000 for 2013 to $46,410 projected for 2014. Am I looking at this correctly?
You're looking at the 80% or?
Looking at Exhibit 3.
Right.
Exhibit 3.
Right, so you're looking at a $4 million, 9.5% increase to the taxpayer.
So even with the 80% plan.
Correct.
Trying to take off the table, even with that, we're still increasing county costs by $4.5 million, correct?
Correct, that's correct. And we're increasing the employee contribution to the insurance by $7 million.
If I do the same thing.
Correct.
We're adding almost $10 million to county costs.
That's correct.
And for Exhibit 4, approximately $8.5 million.
Yes, that's correct.
Okay, the motion on the floor is to remove from consideration Exhibit number 3. Someone wants to say something back there?
Stevenson, I believe you have someone that needs you in the back of the room.
Exhibit 3, how much more does that put on the employees, did you say?
I'm sorry, sir, I was talking.
Exhibit 3, how much more does that put on the employee?
On Exhibit 3, so the way that you go at Jay and highlight
put
that
$7
for
million on the employee.
Yes, sir, that's correct.
$7 million on the
Right,
employee and
that's
$4
correct.
million on the county.
Show them the box, highlight on the screen so
Yep,
people
the yellow
can see.
over at the right.
Yes, sir, that's correct. That box right there shows you currently,
Right there.
that's what we're looking at, and then what it moves to. That is correct.
Exhibit 2 puts
$10 million on the county, roughly.
million on the $1.5 million on the employee.
Right.
Okay, does anyone have further discussion about Exhibit 3? That moves the employee responsibility from $1.5 million up to $7 million. That's what we were asked to prepare those numbers. But we have a motion to remove that from consideration. Any other discussion? All of you in favor of that, please say aye. Aye. Are there any opposed? No. 1, 2 noes. Mr. Hester and Mr. McAdoo. All right. So what's still on the table for discussion is number 4.
Number 2.
And number 2.
So number 2 is plan changes and employee contribution adjusted, 90%, 87%, and HRA 100%. Mr. Sandvig?
Yes, sir.
I would like to propose that we accept the 90%, 87%, because this is still, rocking that percentage is a steep increase for our employees. But I would like to, from the remaining proposal for the HRA or the dependent coverage, take the 98, 99, 97. That would be revenue neutral until.
Okay, so we can do that on the screen to show the impacts of that.
Let's see now. What is he suggesting?
So what he's saying is that for the copay plan, the contribution would be 90% single coverage, 87% all other tiers. And the same would apply for the deductible plan. For the HRA, we would pay 100% employee coverage, 98% employee plus spouse, 99% employee plus child, and 97% employee plus child. Is that correct? And family, is that correct? Okay. Yes, so we're going to show it for on the screen. So on the 8, you're on option 2, and it's a hybrid. So basically what would happen is the copay and deductible sections of option 2 would stay the same, and we would adopt the HRA recommendation on option 4, which moves, as you can see on the screen. Now go over to the yellow box and let them see what the impacts of that would be. And so the impacts of that would be that you would go from 4.4 million to 6 million on employees, whereas if you don't take that HRA change, it goes from 4.4 to 5.8. So we pick up a couple $100,000 there, a little under. And then you can see the difference to the employer portion actually drops from 52,177,858 to 51,918,829.
About $250,000 swing.
Right. If that's the difference in the two, I can tell you quickly.
Yes, it's just a tiny bit over 9.5.
That's right.
We're moving in the right direction. Ms. Grace?
Are you still going to raise their deductible and out-of-pocket, and they're still going to have a $2,000 donut hole that they're going to have to pay out-of-pocket all at one time?
On the HRA?
Yeah. If for a family, you're going to have that $2,000
I just want to make sure you're talking about. Yes, that's correct. But likewise, they're going to get they still get their $750 from the county, or $1,500, and their premium is still very minimal. And once they meet their annual out-of-pocket, that plan pays at 90%. They only pay 10% of the actual billed amount, what ends up after insurance is owed by the employee. Whereas on the deductible plan, it's 80%. And then the copay depends on whether or not it's a service that pays at 80% or you pay copay amount.
$31 a month for the employee plus family is not even $400 a year.
If you go out to the market and you look at like an HSA, which functions a little bit differently, you're going to pay a whole lot more than $30 for family coverage.
Okay, so do we have a motion on the table, Ms. Anderson? We have a motion? Don't have a second yet?
Correct.
Ms. Harvey's going to second the motion. Discussion.
They still net that much.
Okay, if there's no other discussion, we're ready to vote. All of you in favor of this motion, which is a hybrid plan between the first two components for copay and the deductible stay the same as on Exhibit 2, and then the HRA is what you've got on Exhibit 4.
Yes, that's correct.
Okay, all in favor of that, please say aye. Aye. Getting weak. How many are opposed? All right, We're going to have a roll call vote. There's more than two there. Ms. Anderson, call the roll.
Here we go. Donna Andrews. This is the motion made by Mr. Sandvik to accept the county funding at 87% for the copay and the deductible plans, but the HRA plan would move to 100%, 98, and 99%. The 100% to the employee, 98% employee plus spouse, 99 for employee plus child.
97 employee plus family.
You understand that now? You have to put those two pages together. All right, so Ms. Anderson, call the roll on that.
Don Andrews. Susan Boney. Mayor Burgess.
No.
Elizabeth Crace. Commissioner Ely. Virgil Gammon. Greg Hall. Regina Harvey. Donnie Hester. Mary Hickerson. Commissioner Jordan. Commissioner McAdoo. Joe Russell. Jeff Sandvik. 7 yes, 7 no.
Motion failed. So where are we? We still got to have another motion of some sort.
Motion to approve option 4 as is, where everybody thinks
Read option 4.
Yeah. Motion to approve option 4. Let me get a second before we read it. Who's going with that? All right, Mr. Jordan and another second or more.
Okay, so
Let her read it. Let her explain to you what you're voting on.
he's changing it right now. So the motion on the table is to accept employee copay single at 90% contribution, employee plus spouse copay at 86% contribution, employee plus child copay at 87% contribution, employee plus family copay at 85% contribution. For the deductible plan, employee individual at 90% contribution, employee plus spouse at 84% contribution, employee plus child at 85% contribution, employee plus family at 83% contribution. For the HRA, employee individual at 100% contribution, employee plus spouse at 98% contribution, employee plus child at 99% contribution, employee plus family at 97% contribution.
Okay, do you understand that? She's read the numbers off of Exhibit 4. Mr. Sandvik?
Hopefully my math is right. That is for employee plus family in the copay plan, a 76% increase.
$77 increase. Which would be?
I did the deductible plan.
So it's about a 50% increase.
Overall, for employees, it represents a 63.1% increase to current premium levels.
It covers $2.5 million of the $12 million shortfall.
It's a 19.9% increase to the taxpayers, which is exactly what we passed last year.
Okay. Mr. Sandvik.
And I went through and reconsolidated the draft of the GPS budget with these different changes, and I only came up with about an $800,000 change to the GPS budget. I do have federal, some cafeteria. But I did not come up with as much of a change. I was kind of concerned.
So all of us together have to come up with 2.7 million or thereabouts. So you're saying you only got less than $1 million for GPS?
Maybe with the other funds, I'm close to $1 million, but I did not see that big a difference when I reconsolidated. I went through the process a couple of times.
We can confirm these numbers, but other questions whilst they're...
I did go through and balance the participation I used in my budget with the numbers we had in the system in January. That's my concern.
But did you use the enrollment numbers that we have here for the purposes of demonstration? Because these numbers would have been as of January 31st. Is that correct, Mr. Huffman?
And okay.
Updated through March.
I used probably February numbers from the system.
Well, when you add up the number of people enrolled that they have printed out here on these sheets, they look about right.
So if you look at the total over to the right, far right, before it says total annualized, you look at 2013 rate, total 2014 proposed, different in premium. We don't look at this contribution stuff. And you, okay, that was my next question. Yeah, okay. Okay.
That would be about right because we've got 2.7 on the whole thing. All right, we have a motion on the floor to accept what we have here listed on Exhibit 4. All of you in favor of this, then please say aye. Aye. Any noes? No. Call the roll.
Donna Andrews. Susan Boney. Mayor Burgess.
Yes.
Elizabeth Crace. Commissioner Ely. Virgil Gammon. Craig Hall. Regina Harvey. Donnie Hester. Mary Hickerson. Commissioner Jordan. Commissioner McAdoo. Joe Russell. Jeff Sandvig. 8 yes.
Right, motion passed. We have adopted the recommendations on Exhibit 4. Oh. Any other business to come before this body? Ms. Hickerson.
I'd like to make one more motion to make all the accounting even, that we pass the premium increases we needed to the employee at a rate rounded to the nearest dollar. Take all the coins off the table. Let's go to the nearest dollar.
Wait just a minute. Are you going to round them? If it's over 0.5, is it going to round up? Are you?
If you don't make it the next nearest, then we're going to end up short on budget because you're going to have to then go in and reduce it on the other side. The easiest thing to do is round it to the next nearest, roll it up.
Well, and the
0.49
issue,
or under, it's rounded off, and if it's 0.5 or over, it's rounded up. Mr. Sandberg?
The issue that we face on rounding is when you take a rate and divide it by 12, and I take a rate and divide it by 10, we have rounding differences. And we need to decide what...
That's a good point.
Unless we do $12, well, there's not a, just we will have rounding differences, and that could go.
Well, first of all, Ms. Hickerson, I didn't get a second on that motion, so I allowed discussion before we got that. Do we have a second to her motion? Okay, Ms. Hickerson, sorry, but that motion failed for lack of a second. Thank you. Any other discussion?
I have one more point of discussion for the group. Sorry to do this. During the work session, we talked about a wellness credit. It's part of our premium proposal, and that was where we were going to apply an additional $25 on top of the rates that were determined, which you've determined option 4. And then we would do biometric screenings, and for anyone that participated under the guidelines of the biometric screening within the required time frame, then they would have that $25 reduced. So in essence, what would happen under that proposal would be The 2014 proposed 50-60 would go to 75-60. And if they do the biometrics, they get the $25 and it's back down to $50.60. If they don't, then they pay the higher rate. And since this was brought up for discussion and it was as a follow-up item, I wanted to present that to the group.
That $50.60.
So if you look at what was just passed on the copay plan individual employee, the 2014 premium will be $50.60. We would apply a $25 on top of that number, and if they take the biometric test within the required time frame and apply to all the rules of the process, then they would receive that credit back, and their premium would still be $50.60.
Does that apply only to copay?
To all.
All three of them?
Anyone enrolled in the insurance.
So the HRA plan, they're paying $0, but they would then pay $25.
If they didn't do the biometric screening. Because what we've done today is we've addressed the problem. What we haven't done is address how to control future problems. And that's what this proposal is meant to do. This process was hard.
Okay.
But we've got to also do things to help control future. And you may not be prepared for it today, but it was discussed, so I wanted to bring it for consideration.
Grace?
You want to discuss?
Yeah, and the reason this was brought up initially, as we were going through the utilization of the county's claims dollar, it was noticed that there's very low utilization in the Cigna disease management programs. And so the thought was, if we can encourage employees to get an annual exam or biometric screening, and that data feeds through the Cigna utilization system, then it will reach out their health coaches to the members, whether it be for, diabetes, weight management, nutrition, smoking cessation programs. And so we're trying to get more interactive in that outreach to affect next year's increase, because essentially we've had a couple increases in a row. Really, we just, as we were saying, fix the problem as it is today, but I am hopeful that we come back next year with a lower increase. And so we're trying to also do some things to move that trend line next year.
A lower increase in terms of what it would be if we didn't do any proactive approach.
Okay, so do you need action on this today, or what's
We would, yes, sir.
This is just as needed, as timely as what we've already been discussing. Ms. Harvey?
I think I see the problem of requiring someone to do something, on their own time, that they have to come for this, or talk to someone on the phone for their health coach or whatever. I know personally I have signed up for the program, and my health coach calls my home during the school day. So I never talk to my health coach because they call during school hours when I'm working. So I think we're just, with increases that we're given and keeping up who's doing what, and are we going to take this amount off or keep this amount? I think we've done so much on raising premiums today. I don't think we need to add another burden on the employees.
Other comments? Do we have any sort of motion to address this or not address this? You make a motion. What I think she's saying is if we don't know as we go through this budget process whether we're going to do this or not, we won't be able to get it in the...
It will be 100% employee paid, Mayor, so we could do it in the May meeting, I guess.
Do it later?
But I suspect, I don't see a problem, do you, Jay, if we do it next month? We would have to make a decision next month because then we start developing open enrollment materials. For the purposes of understanding county budget, we've completed that today, assuming it passes through full commission.
We have time to put it in the open enrollment discussion later.
Yes.
All right, without objection, this will be on the agenda next go-round. Okay? Any other business? If not, this meeting is adjourned. Thank you very much. And first of all, before we adjourn, thank Melissa and Mr. Brown for being able to provide on the fly, you might say, updated information that helps us make good decisions. Thank you very much. We appreciate it.